Thank you very much for that. We are very grateful to Professor Suranjali Tandon and the National Institute of Public Finance and Policy for hosting our global event this year. The mission of the Global Tax Symposium is to be the first interdisciplinary mobile research platform on fundamental issues of international and comparative taxation. It is grounded on the belief that crossing African, American, Asian Pacific, and European perspectives is beneficial to all participants, especially in the current political and economic global context. It aims to offer young researchers and experienced scholars a forum in which to discuss 5 to 6 papers every year in different cities on all continents. Each paper is discussed by an interdisciplinary and intercontinental panel whose members are leading tax academics, tax practitioners, tax officials, and tax policy makers. As Suranjali said, this year we will be discussing 6 papers, launching 2 new books, and holding 2 panel discussions. They're all focusing on the new frontiers of international taxation. I am delighted to invite Ruben Avillona, Professor of Law, Michigan Law School, University of Michigan, to present his latest paper entitled The Interaction Between Unilateralism and Multilateralism in International Tax. Ruben, a very warm welcome, and over to you.
Thank you very much, Eduardo, and thanks, Suranjali, and everybody this is an amazing endeavor, I have to say, with people really from all over the world. And this is the one silver lining from the pandemic is that this sort of thing has now become possible. And, you know, I was telling people before, I hate teaching on Zoom, but I love doing this because you can really get a worldwide audience and participate and meet a lot of people that wouldn't be possible if this was all in person. So let me share my screen. Okay, so the idea is to talk about unilateralism and multilateralism in taxation. And this is, of course, timely because, let's do slideshow, simply because, you know, there's all of this discussion now about the Multilateral Tax Convention, which is not a new idea, but it seems more relevant at present because of the need to do such a thing if you want to achieve Pillar 1 in particular. So traditionally, there's been this tension between bilateralism and multilateralism in tax. And in that case, I mean, what's strange about tax, of course, is that most other international economic regimes are not based entirely on bilateral treaties. So the trade law, as you all know, is multilateral. You know, all the treaties are signed by, you know, most of the world's countries. And the investment regime, the bilateral investment treaties, despite their name, are not really bilateral in the sense that they all have most favored nation clauses. So, you know, provisions from one treaty can migrate into another treaty based on the MFN. And that, of course, does not exist in tax. And part of the issue is simply that tax is older, as you know, tax was developed in the interwar period, whereas the trade only started after World War II, and the investment treaties basically also the modern versions of them. So the League of Nations between the wars tried to negotiate an MTC several times. There were extensive discussions, but eventually they concluded that this is not realistic given the differences in the tax policy and law between the various countries, even though it was a smaller number of countries back then. And so they worked, as you all know, on the bilateral double tax treaties, first on the models from 1928 on, and then, you know, actual treaties like the US-French treaty from 1932 and several others before World War II. And you know, the Mexican model from 1943, the London model 1946, this was all the League of Nations work. Then the mantle was taken over, as you know, by the OECD, with the first OECD model from 1963, and then you get the UN model from 1980 on, and so on. And this is all now an immense network of double tax conventions that are over 3,000 by now, and they encompass the world. But from the beginning, it was clear that there are problems with the network, and one obvious one that has attracted a lot of attention from more or less the beginning is the so-called triangular cases. That is situations, for example, where you have a treaty between two countries, but one of the countries has a resident with a PE in a third country, and that's not covered by the treaty, and this creates all kinds of complicated issues. In addition, in recent years, but recent, I mean, since the advent of globalization in the 1980s, there were two particular problems with particular provisions of the double tax conventions, namely the permanent establishment rule and the arm's length standard. So the PE rule stems from, it's even older than the League of Nations. It comes from the Austria-Prussia tax treaty from 1899. And it was adopted by the League of Nations drafters as a way to limit source-based taxation of multinationals that do not have a significant presence in the country. So you need some kind of physical presence directly or through a dependent agent. The arm's length standard is later. It was essentially invented by Michel Carroll in the 1930s based on his work at the US Treasury Department, because it's incorporated in the France-US treaty from 1932 and in the US regulations that were adopted in 1935. And those were problematic as globalization happened, because it became clear, especially after the invention of the internet, but even before that, that multinationals can derive a lot of income from a country without having a PE, and also that the arm's length standard doesn't work for modern multinationals because there are no comparables in the vast majority of cases. So even before 1995, when the internet was created, there was pressure on these. And for example, I know Sol Pichotto's in the audience. He pointed out these problems in 1992 in his book, again, before the internet. So it's not just about the digital taxation. But this, of course, became worse with the advent of so-called electronic commerce. And then there's the new development that is post-2010. So we have the multilateral instrument in BEPS 1 from 2015. But that's not really a multilateral tax treaty, because it's an overlay on the bilateral ones. And each two countries need to agree in order to implement the MLI. And they usually can choose which provisions exactly to implement and which not, except for the minimum standards. And so as I don't regard the MLI as a real multilateral tax convention. A real multilateral tax convention, which is similar to the WTO agreements, is now on the table because of Pillar 1, which requires it because for Amount A, it overrides the PE and arm's length standard limitation. Now, there's another part of the story, though, that I want to highlight because it may be a little less familiar to an international audience, and that is simply the really immense influence of the United States on the international tax regime from the beginning until around 2010. So here's a list of provisions that were all originated in the United States and then were adopted by the rest of the world, more or less. So the foreign tax credit from 1918, the arm's length standard, which, as I mentioned, was invented by Carroll in the 1930s, foreign investment funds in 1937, controlled foreign corporation 1962, the modern the classical transfer pricing method from 1968, the Foreign Investment and Real Property Tax Act from 1980, limitation on benefits 1981, the branch profit tax 1996, the modern profit-based transfer pricing methods in 1995, the anti-hybrid rules that, of course, are now in BEPS 1, but the first one was, I think, in the US in 1997, and most recently FATCA in 2010, which was then led to the CRS and the multilateral agreement on administrative cooperation in tax matters, right? So these are all instances where the United States influenced the rest of the world. And my view is that this was by and large constructive, meaning helpful to the prevention of both double taxation and double non-taxation. Now, there are other instances where the United States did things unilaterally that were terrible, such as the portfolio interest exemption in 1984 and the check the box rule in 1997. These were both disastrous for the international tax regime. But most of the time, the United States was helpful, I think. Even though, of course, from the perspective of other countries, it was the action of the hegemon, basically, imposing stuff, or not quite imposing, but doing stuff that created pressure for the rest of the world to follow significantly. But in many cases, I think the OECD, while being influenced by the United States, you did need to get a consensus unanimously for all these things. So you can't really say that the United States entirely forced this thing on the rest of the world. So then we get to recent developments. And so we have BEPS 1.0 from 2013 to 2015, but that explicitly was led by the EU, not by the United States. The United States was kind of pushing back and trying to limit. So, that's the reason that we didn't get anything on Action 1. But all the provisions in BEPS 1.0, the original one, were basically EU-led, not US-led. Then you get the Tax Cuts and Jobs Act in 2017 in the US, and that went beyond BEPS 1.0 because it included GILTI and BEAT, which were unilateral moves, but that significantly increased US taxation, both outbound and inbound. And that's what led, I think, to the development of the current BEPS effort. But you have to distinguish between Pillar 1 and Pillar 2, because Pillar 1 is, of course, primarily the EU and other countries too, trying to make sure that the US digital giants are paying tax. Now it's been expanded under US counter pressure to include other multinationals as well, so as not to be discriminatory, but nevertheless, that's the primary target. As opposed to Pillar 2, which is clearly inspired by the TCJA. The whole idea of the global minimum tax is a combination of GILTI and BEAT, of course, with modification, but nevertheless, that's where it's coming from. Now, the other big difference in the current context, of course, is that Pillar 1 absolutely requires a multilateral tax convention because you need to override the PE and arm's length standard limitation in every tax treaty. But Pillar 2 does not require multilateral tax convention because countries can adopt it unilaterally, as now is the position of the large EU countries as well as many other countries around the world. So now, in terms of the current situation, the question is, will there be a multilateral tax convention for Pillar 1? And here I am skeptical for a whole number of reasons. First of all, we're talking about more than 100 jurisdictions, right? And even though there's an agreement in principle by all of them, except with there are few exceptions that explicitly did not sign on. But it's a lot of countries. And as the League of Nations discovered, that's hard. Especially since there's no agreement, I think, on the fundamental goals here, in the sense that there's tension between, for example, countries that host large multinationals and countries that don't. That's a significant difference. There are also, of course, revenue issues. Some countries win, some countries lose. And some of the countries that did not sign on, like Nigeria, explicitly says, we're going to lose from this, so we're not going to be willing to sign on. But even other countries that did sign on under kind of peer pressure may not actually proceed once they do the revenue analysis. Then there is, of course, a very big problem in the United States. Unlike Pillar 2, Pillar 1 requires the US to participate because the main target is the US multinationals, and the US is simply not going to participate. That's clear. Even before the last election, it was clear because for a treaty, you need to get 67 votes in the Senate. That's not going to happen. Now the Republicans have taken the House. And so even a so-called executive agreement that passes through Congress is not possible. So there's not going to be any US participation in this. And that's an issue because without US participation, this country will not give up on the DSTs. And if that's the case, then the whole thing, I think, doesn't work. As opposed to Pillar 2, which is well on its way of being implemented with all of these large countries signing on. And despite the problems and the counter arguments, I do think that Pillar 2 will happen. And now, of course, the point is that Pillar 2 really requires only the participation of the G20 or even a smaller club of countries where multinationals are by and large resident. And if all of these countries go along, then it's fine. And my view is that substantively, the United States is already compliant with Pillar 2 because of the combination of GILTI and the new corporate alternative minimum tax, which is a 50% tax based on book income. Now, there are differences. It's not country by country. There are credits and so on. But I think that all can be resolved diplomatically. I mean, that's my view. And the contrast between the Pillar 1 MTC is the Multilateral Agreement on Administrative Cooperation in Tax Matter and the CRS, which really was adopted by the entire world, basically, other than the United States. And it also involves a lot of countries. But here, because of FATCA, there was a lot of pressure on countries to go along. And also, there's less. This is about tax evasion, so there's less disagreement on the goals. So that's why it was possible. Now, personally, I would love to see an MTC. And I like Pillar 1, and I believe in Pillar 1, and I think Pillar 1 is correct in assigning at least some income to destination jurisdictions. And I would encourage countries to do it unilaterally, like the Indians have proposed before the Pillar 1 negotiation. I think that would be fine too, even though there's not going to be a foreign tax credit for it in the United States. But nevertheless, I think Pillar 1, as currently envisaged, is unlikely to happen, and therefore we're not likely to have a multilateral convention in tax matters anytime soon. And with that, I think I've reached my time limit, so let me stop and listen to the comments.
Thank you very much, Ruben. Now I am delighted to invite an intercontinental panel of discussants. Allison Christian, who is a tax law professor at McGill University in Canada. And then I will be inviting Joachim English, professor of public law and tax law, University of Munster in Germany. Allison, over to you, please.
Thank you so much. Well, as usual, it's just a delight and a pleasure to be with all of you. And well, all of you know that Reuven's work has been influential all over the world, and I have used his work in everything I've ever done. I love everything you do, Reuven, you know this, but I disagree with everything you've done here. So that's not, I'm exaggerating, but only a little bit. So I think the thing that I love about the paper, which I find just elegant and really useful to even to somebody who's brand new to international tax, is it gives us actually a timeline of the significant events that have led to where we are today, although you didn't actually put them in order. That really disturbed me, Reuven. I wanted them in order. And so I put them in order for myself and sort of thought, I think there's a few things missing. And I wanted to talk about a couple of the things that are missing. And then once I put them in order, I thought, you know what you owe us, Reuven? You owe us a scorecard, and you can give the US 1 point each time the thing that happens was net good for the world, but you have to take away points for all the ones that are net bad for the world. And I wonder if we both did that, or if we all did this on our panel, would the US come out ahead? Would it be a net positive, net good force in the world, or a net bad force in the world? And I think net bad. I think net bad, and I'll say why overall. But that's because I give like -1 million points for the portfolio interest exemption, and I give -1 million points for check the box and some other things. So let's just start with a couple of things I think that are missing, and I'm just puzzling over them. I'm not actually sure how they fit into the narrative, but I think they do, and they're important to get in there. One is, in the 70s, the discussion about arbitration starts, I think, in Norway. I think in the Scandinavian countries is where that discussion starts. And I am no expert on that history. I just pull that out. But I think that there's a story somewhere along the line where the US takes a position on arbitration and then influences that discussion. And now that arbitration has become such an important part of dispute resolution, and now that dispute resolution is where all of the problems end up really, playing out, I think that story has to be told in this timeline. And of course, that's somewhere at the same time as the transfer pricing regs, somewhere between the transfer pricing regs in the US and the OECD adopting them in 77 is when, so that's not coincidental, right? Like transfer pricing, expansion, and this idea that, wow, we have these disputes that we are going to have to resolve, and we've been using a diplomatic process that's very, genteel, but perhaps not too satisfying. So I would put that in there. And then I think the big one that's missing for me, the OECD harmful tax practices, 1998. I think you really have to give the US minus a few thousand points for that behavior, because the US was in the OECD, agreeing, shaping, molding, and then you have that regime change, George Bush, and then of course they withdraw their support and in fact push against it. And we've seen that repeated, and that pattern has been repeated kind of over and over. I think you mentioned it in a few other ways where we repeat, or the US, sorry, I said we, but it's you repeat that pattern over and over. And I think those are important steps to note, that whether that's unilateral or multilateral is actually debatable. Like, what does it mean to say multilateral or unilateral when we know right from the first mention of the US in the international context in your paper, which is the League of Nations and Seligman's influence. But let's all remember that the US was not a member of the League of Nations at that time. So I think that unilateral, multilateral, I love that you work through this, but I think there's something to be said about, well, what does that mean to say multilateralism in the case of the US when we know they're not going to be formal, sometimes they're not a formal member of the institution, and sometimes they don't formally adopt whatever the rule, and there's something going on there. So arbitration in the 70s, the HTP, and then like, what about the TIAs? The tax information exchange agreements, well, those also start when the US signs that with Antigua and the Caymans in 2005, 2000, I think, early 2000s. And the US signs a bunch, and then all, those take off. Net good or net bad? I mean, a little bit debatable what those agreements did, because of course they led to an idea that, well, you could have 12 TIAs and then you were A-OK, and that was kind of a messy bit of history of our international system as well. So I'm not sure if I would give points or take away points there, but how about 2004, the jitsik? You'll remember it was originally the Joint International Tax Shelter Information Center, and then later it was the Joint International Task Force on Shared Information and Collaboration. The US was a member of jitsik early on. I think there were, a handful of countries. And that's really the precursor to a lot of the information exchange that ends up, or not just information exchange, but like assistance in collection. But even that we can date back to the 30s, the US agreement with Sweden having, much more information exchange and sharing. And then what about the 2018 icap? You talk about transfer pricing and APAs, but the icap, this International Compliance Assurance Program, this pilot project in 2018, the US is a big part of that too. And I think that's I think you get some points for that one. That seems like, and that is truly multilateral, right? Because that is trying to solve the problem of bilateral APAs without the long timeline that is required for a multilateral APA. And icap slides in there in the middle of that problem with a kind of a pretty unique administrative soft law position. I mean, I think, you get some points for that as well. And then the only other thing I wanted to add to the timeline, I actually don't know how to think about this one. You do mention the Starbucks phenomenon leading to like the tax justice movement in Europe and not having the same impact in the US. In fact, almost drawing the opposite impact in the US with Apple kind of like being praised for not paying taxes, although that did end up in the state aid context. But what about this country by country reporting movement? Like, where is the US on that? Because there's some it's obviously starts in the Tax Justice Network as an accounting standard. It's a disclosure, or in theory, it starts out as a corporate disclosure regime. I think the US was not a leader in that and has resisted it, and American companies have resisted it. And so I think that's part of the story too. So in terms of that timeline, all my, I want to add some things, and I want to, I want a scorecard, and I want to, think about like net good, net bad. But also, I think each of the events, what I think you've, so wonderfully done here is you've shown us that, wow, some things that you think that are sort of unilateral are actually more multilateral. And a lot of what we call unilateral is multilateral in some way. It is negotiated. And that brings me then to, if I still have time, I actually didn't ask how much time I had. And okay, so
6 minutes, please.
Oh, excellent, great. Okay, won't need 6 minutes, I don't think, but you never know. So that leads me to the rest of the paper. So I struggled a little bit with the structure of the paper. Like I just wasn't sure where it was going, or like how the pieces fit together. But I got it a little bit better once I heard you, talk through it. I started to understand where you were going. So we get, I think, to this idea that Pillar 1 needs a multilateral, and you said Pillar 2 does not need a multilateral. I think that's a little up for debate. There's obviously a lot of discussion going on about the UTPR recently. Anybody who's been in LinkedIn has probably seen a whole lot of discussion about international law, Reuven's customary international law thesis, with which I disagree, being absolutely, used as a real strong force against the UTPR. I think these are interesting times, really, because now we're coming to this place of reconciliation with what we think we know about our international tax system. Like, what are the things that we know? Well, we know that CFCs are fine. They don't break sovereignty or break the corporate veil or break the notion of the corporation, because they were talking about controlling from top to bottom. But UTPR must be not okay because it's bottom up. And we are revisiting, well, what are you allowed to tax? Like, can you, as in the Monty Python skit, tax all foreigners living abroad? Is that a thing you can do? Well, of course you can. The one big thing that the US has done that no other country has followed except for Eritrea, and you know exactly where I'm going, I don't even have to say it, Reuven knows, it's citizenship-based taxation. So there's a lot of precedent that it's hard to explain it. You can't, you try to say that there's a flow, there's a journey of international tax law, and you can see the movement of ideas and the US being a leader, being a strong voice, but not always being followed, and sometimes being followed for things that don't seem great for the rest of the world, and sometimes not being followed for things that maybe it wouldn't be so objectionable. I don't know. So I like this story that you're telling. But I just, for me personally, I think I would love to have that sort of classic Reuven explanation, pulling it all together and giving us, explain this, what we mean when we say multilateralism and what we mean when we say unilateralism. They're not actually two different things. There's something very hard to explain about both of those. They're just not clean categories. And then the last thing I'll say I struggled, and this is just a technical detail and has nothing to do with the rest of the paper, but in your third to last paragraph, you said that the corporate AMT will turn off the QDMTT. Well, that just can't be right, Ruben. That just cannot be right. The QDMTT is an AMT at source. I don't see how any other tax could get in the way of that. So we have to have a debate about that at some point.
No, that's just a mistake. I meant turn off the UTPR.
Okay, okay. It would turn off the UTPR. Yes, I agree. I think it would. Yes. Okay. I feel better about that. Good. Hey, everybody. I just agreed with Ruben. So I will say at the end of the day, I just found this paper a pleasure to read. I will use it. I will put it in chronological order for myself. I will consult it often. It will be a paper that I think will be influential. And I'm just delighted that I got the chance to come here today and talk with you about it. And that's all I have for you. Thank you.
Thank you very much, Allison. And let's move from North America to Europe. And I'm very happy to invite Joachim English, Professor of Public Law and Tax Law from the University of Munster. Joachim, over to you, please.
Thank you very much, Eduardo. Thank you very much for having me here and for giving me the honor to discuss Ruben's paper. Always a pleasure, of course, to read his papers. And now I really had to study it in depth, and that was even more of a pleasure. So the paper really presents and offers an insightful analysis of international tax law from a certain perspective of unilateral measures influencing multilateral solutions. And with the research design, and this is a point that I want to specify a bit further in my comment, that it comprises both an empirical element and a normative element. So as regards the empirical element, Ruben, you demonstrate how unilateral national tax reforms, mostly originating in the US, have led to a multilateral proliferation, or what you call multilateral proliferation of the relevant tax regimes. And you forcefully argue that through such unilaterally enacted regimes, the US in particular has been a de facto leader of multilateral standard setting in the international tax system for almost 100 years. And then in the wake of the Great Recession, the EU are taking the helm and doing a similar thing through the OECD. And you end your empirical analysis, and this is also where your presentation today went a bit further than, with the finding that while unilateral measures still play a certain role, we now have rather a mutually reinforcing constructive dialogue between the US and the EU. So that's the empirical part, I think. And then mixed with that empirical part is some normative element, because you distinguish quite often between what you consider constructive unilateralism on the one hand and destructive unilateralism on the other hand. So some of those regimes and initiatives that you discuss, indeed the majority, you qualify as positive developments, and some others as bad tax policy. So I will divide my comment a little bit in those two aspects. I'll start with the descriptive aspects of the paper. And I think obviously the descriptive part is very well researched and is very concisely written. So it really needs nicely, it gives a great overview. I would agree with Allison, and I will make a few more comments on that in a few more minutes, that a few things maybe are missing that you might wish to see there. But basically, it really gives you a very good idea of how unilateral measures are taken by the US transpired into the international tax system and also partly drove its development. And I particularly enjoyed how you confute the general narrative that the US has not endorsed the BEPS 1.0 standards by dissecting the TCJA reform of 2017. I found that very convincing. Now, I wonder, however, and that goes partly in the direction of a comment that Allison has made, whether all the 10 instances or 10-ish instances or so that you give for the US tax leadership in the period of 1928 onwards, whether all of those instances really gave rise to multilateralism in international tax in a strict sense. So in my view, it might be argued that some of those developments merely had what I would call an international spillover effect, and they gave rise to legal transplants and sometimes also to cross-fertilization of ideas and concepts in international tax law, but they did not lead to genuinely multilaterally coordinated solutions in a strict sense. So here I would suggest a more terminological clarity maybe. An example for this could be the CFC regimes originating in the US being adopted by other countries, but until very recently, if you like, hardly multilaterally coordinated. Now, where we do have multilateral agreements on certain standards emerging, I think it would be great to learn a bit more how proactively the US actually pushed for this multilateralization. So did it just happen, or did it happen? And of course, it's the intuition, because the US put some pressure behind it to get it adopted at the international level. And in particular, I miss a bit in this paper the context given by international institutions, then the OECD, in particular the OECD as in its role as a facilitator of a broker of multilateral solutions. And it would be really great to hear a bit more about the inner dynamics of the institution and the outsized role of the US. So you said in your presentation, well, you know, if everyone agreed, if there was a consensus, you can't really say the US forced this upon the world. And yeah, again, in the strict sense of forcing something upon someone, probably not, but you know, there is a range of pressure that you can exert, and it would be good to have some ideas about how the US made that happen, to the extent that they actually worked on making it happen. Amber, I realize you can't have a paper on you know, the sociology of the OECD within this paper, but to hear some words of this, it would be really interesting. And such analysis could then also allow, and this is why I think it's important for the thrust of the paper, some conclusions towards the end, whether what we see now, what you describe as constructive dialogue between different unilateral standard setters, is just a temporary phenomenon, or maybe a rather signaling a lasting change. In particular, what's the role of the inclusive framework in this concept? Does it have some potential to change the dynamics that we described for the past 100 years, or do you think rather not? And now I think I still have a bit time, right? Another
8 minutes.
8 minutes, yeah. So I will then comment also on the normative dimension of the study. So I think your empirical analysis is really a great foundation. So in this way, it's also a great foundational paper, which I enjoyed a lot, for a lot of normative discussions you could then have on the basis of your insights. You might, for example, consider to discuss the relative importance of this phenomenon, and this is also something that Allison has pointed out already, in comparison to other instances where we had rather multilateral activities first and then proliferating into domestic tax systems or the bilateral treaty network, rather than the other way around of unilateral pioneering. So what is the relative importance of those two movements? You could discuss how those dynamics, as you describe them, from US unilateral action into a multilateral system, or let's say into an international tax system, how that maybe exacerbated the global north, global south divide, how it led to countries feeling that they're being patronized, etc. You hinted at that in your presentation. I think it might be a little bit further explored in future research. But I also acknowledge I found that a good limitation, that in your normative analysis, you focused on a different aspect, namely on the question whether the unilateral actions were actually constructive or destructive, and the underlying value judgment being the question whether they contributed or not to the implementation of the single tax principle. So it's destructive if it increased the risk of double taxation or double none, or reduced taxation, and vice versa. Now, in your paper, not much is said about the merits of the single tax principle. Might not be obvious to everyone, but I
think I've said enough about that in a zillion other papers, right?
Yeah, exactly. I was just about to say, you have really elaborated on that on other publications. So I think that's not really a problem. And therefore, my main comment is really a suggestion that you might want to further refine those two categories, constructive versus destructive unilateralism, because I think if you look closer, there's actually two different categories or subcategories of unilateral action and its interaction with multilateralization, which should be distinguished. I will say why in a minute, but first I will say what kind of two subcategories I have in mind. First, you discuss some unilateral measures which already in itself support or obstruct the single tax principle. So constructive measure here makes a positive contribution already as a unilateral regime, which is then merely, if you like, enhanced when it's copied by other jurisdictions, or eventually it transpires into an international consensus or multilaterally coordinated solution. And destructive measures here by themselves already unilaterally adopted create conditions that risk double taxation or double non-taxation, and this might then or might not proliferate internationally. So crucially, the international or multilateral repercussions are not decisive here in these categories for the characterization as destructive or constructive. So examples here positively would be the CFC regime, the LOB clauses. Negative examples would, I think, be check the box or the portfolio interest exemption. But then second, you also qualify some unilateral measures as constructive unilateralism precisely because they forged an international consensus. They led to multilateral solutions regarding the allocation of taxing rights. And it is only then through the multilateralization of those unilateral approaches that we actually get an improvement of the international tax system, that we actually get closer to the single tax principle. And so such measures need not by themselves be good tax policy. And indeed, sometimes you're right, you don't consider them to be, such as, for example, the arm's length principle, the transfer pricing methods, or the foreign investment in real estate rules. And still, because they're uniformly applied globally after the US having pushed for them, we get a reduction in instances of double taxation or double non-taxation. And vice versa, we have instances of destructive unilateralism. They also fall in this second category, where a measure already only becomes destructive because it threatens to undermine the international consensus, the multilateral system, and not because it is bad policy in itself, or because in itself it would necessarily lead to deviation from the single tax principle. And you give one hypothetical example for that, which is if the US were to replace the foreign tax credit by a mere deduction, cum rate reduction, as our colleague Daniel Shavira has proposed. So I think this is a fundamental distinction. Basically, some of the measures you describe are destructive or constructive in themselves, and then their positive or negative effects are merely enhanced, but not grounding in international developments or multilateralization. And then there's some others that are only constructive or destructive precisely because of multilateralization. And I think it's important to make this distinction because as I would strongly endorse, future research building on your analysis is realized on the geopolitical or institutional setting required for unilateralism to generate, so if you say a positive externalities, it's important to distinguish those two features because the conditions, I think, are different for each one of them. I'm not sure if I have a minute more or not, but I don't really have so much more to say, so maybe I'll just take a minute and you interrupt me, Eduardo. Another point I had, but not as important, there's the same direction as Allison has made. I think we don't have just a one-directional channel from unilateral US measures leading to international or multilateral reactions, but also we have, of course, the channel working the opposite direction. So sometimes the US is on the receiving end, if you like, also before 2010 of international or multilateral developments. And here, as Allison has said, it can play a constructive or destructive role as well. And I noted indeed down the defection of the US administration from the 1998 harmful tax practices or harmful tax competition at the time still agreement, which certainly is an example where we have destructive activities of the US on the receiving end of multilateral and unilateral interaction. And the same might happen, as you said, Ruben, with the Pillar 1 implementation. Finally, I think it would be good to be a bit more clear in the definition of constructive and destructive. Once you have read the entire paper, it becomes clear, but there's many ways why you might want to say something is constructive or destructive. And especially, you might regard anything that's unilaterally and then sort of pressured upon the rest of the world as destructive because there is no inclusive process about those standards. And so I realize that's not what you want to discuss in the paper, but I think it would be good to have that bit more explicit. And then I have a few technical comments, but for reasons of time, I will not go into this. And if you're interested, Ruben, I'm happy to send them to you. Thank you.
Joachim, thank you so much for your comments. Now we have some few minutes to open the floor for further comments and questions. And I would like to invite Sol Pichotto, Professor Sol Pichotto, to submit his views. Sol, over to you.
Golly. Thank you very much, Eduardo. I put a comment in the chat. I mean, I thought that Reuven's starting point was quite fruitful to compare international tax with other regimes. And he argued that the trade regime is multilateral, whereas the investment regime, although it's based on bilateral treaties, because of most favored nation clauses, becomes kind of multilateral. But I think that points to the way in which I think all regimes, in a way, are interactions between unilateral initiatives, bilateral agreements, and multilateralization, if you like, because the trade regime itself originated from bilateral trade treaties, most favored nation clauses, the GATT, which was a multilateral most favored nation clause, essentially. It then became probably the most multilateral regime, the World Trade Organization, but that has started to fragment into a lot of bilateral and regional agreements. So I think it might be more fruitful to look at the other end from international tax and to say what would be a fruitful basis for a multilateral convention now. And that's obviously very much on the table now that we have an initiative in the United Nations for a multilateral tax convention. Abdul Chowdhury and I have proposed in the South Centre paper that could take the model of a framework convention along the lines of the climate change. So I think we would need to look at what kind of general principles could be enshrined in a multilateral tax convention. I would suggest probably the most generally acceptable would be an obligation of mutual cooperation, enshrined particularly in the OECD Council of Europe. It started as a Council of Europe initiative for the Convention on Mutual Assistance in Tax, which is probably the most broadly accepted. Although the US hasn't actually joined the convention, as Reuven pointed out, in effect, it's got not an entirely multilateral regime, but it has got very comprehensive arrangements. So I think maybe we look at it the other way. What would be fruitful to multilateralize in the tax area?
Thank you very much, Sol, for that. And I invite Jerome Lammers to comment. Where are you from? Where are you based now, Jerome?
Good morning. Good afternoon, actually. I'm based in Copenhagen right now. Trying to finish my PhD in Amsterdam, by the way. Hopefully, Allison, I will soon. Thank you so much for the presentation. I thought it was incredibly interesting. It made me think about a presentation that Michael Leonard gave a little while ago, I think about a year ago at the Peter Allard School of Law. And he talked about unilateralism and multilateralism like a spectrum, more than sort of two binary points, going from cooperative unilateralism to plurilateralism to Big Bang global multilateralism. And I think it might be important to sort of look at that in that sense, and I'll try to give two examples why that might be. First is, so you've been talking about the US, how they might have been constructive, either constructive or destructive. But the question certainly in the latest policy discussions, who is the US really? Because on the one hand, you have the administration, who seems to be brokers of multilateral solutions. And on the other hand, you have Congress who pulls really at the other end of the rope. So who is the US? So on the one hand, they help, and on the other hand, they tear down. So how does that really play out? And the other remark or question I have is, if you look at the 8 October global agreement, you also said something in your presentation on that. There's a couple of countries that didn't sign up, and those couple of countries tend to be sort of marginalized. So yeah, there's only 4 of them, and there were 137 that did sign up. But if you look at the 2 African countries, they make up 25% of African GDP. And if you look at actually at Africa, who is included in the included framework, there's a whole lot of whites or blind spots, if you will. So multilateralism seems to, and certainly the inclusive framework, seems to imply or promise some kind of global sign-on. But maybe multilateralism, as we know today, doesn't even come above regionalism. So what exactly is multilateralism? I thought it might be interesting to sort of nuance that a little bit.
Thank you very much for that, Jerome. I would like to know if there is any comments from Africa. Is there any comment from Asia? Is there any comment from Asia Pacific? All right, Ruben, you have 2 minutes to answer, please.
All I can say is I'm amazed. This is the best discussion I've had in years in terms of revising the paper, and I will take all of these into account. And I even tend to agree with almost every point that was made, including the stuff that was missing. So this is just absolutely great. I'm next presenting it, in a couple of weeks in person in New Zealand, and this presentation, the next one, will be much, much improved as a result of your commentary. So I really thank Allison and Joachim and Jerome very, very much, and also all of you for inviting me. Thanks.
Thank you very much, Ruben. As you know, you are my intellectual father. I've been quoting you everywhere. What I tried to do in the paper I will be presenting tomorrow, is to see to what extent David Hume may somehow answer some of the questions submitted by Allison and by Joachim and even by Sol. As you know, David Hume and Mancur Olson argued in the 18th and 20th century, respectively, that small human groups are typically better prepared than large groups to protect their interests. So what I do think is that the international tax regime is fundamentally the product of 3 small groups: market jurisdictions, tax hubs, and international investors. So when talking about unilateralism and multilateralism, probably we are fundamentally talking about the interaction between these three small groups, because the large group that consists of developing countries have been unable to coordinate. So I wonder to what extent when the paper talks about unilateralism and multilateralism, the paper is effectively talking about the strategic interaction between 3 small groups only. Once again, thank you very much for such a illuminating paper, Ruben, and very insightful comments by Allison, Joachim, and Sol. Now we have 5 minutes to take a break. See you in 5 minutes. So I think we are ready to start our second session, and I'm delighted to invite Alice Perlot to present her paper, Carbon Leakage, a Threat to the Adoption of Carbon Taxes, a Legal Analysis. Alice Perlot is a research fellow, Law Center of Business Taxation, Said Business School at Oxford. Alice, over to you, and a very warm welcome.
Thank you very much for the invitation. I'm super grateful to the organizer that I have the chance to present this paper here. It's the very first time that I'll present the paper. So yeah, I'm super grateful for the opportunity to you who have been organizing this conference, but also to all the participants, because that's a wonderful opportunity to get constructive comments. And as you can see from the slide, so hopefully you can see my slide on the screen, I'll speak about carbon leakage and carbon taxation. So it's quite a different topic from the previous presentation, but you'll see that there are some links that can be made between the themes that I will discuss and the theme that have been discussed previously. There was one comment that was just made by Eduardo about developing countries not being able to coordinate so well, or not coordinate at all. And you'll see that in the context of climate change, that's a little bit different. So that's one thing I wanted to say. And the other thing I wanted to say is to apologize, because I will not be able to attend the 2 days of the conference, as some of you might have heard. My daughter was born 2 months ago, so I don't think she let me spend 2 days on Zoom and not taking care of her. So unfortunately, I'll not be able to attend every single session, but I apologize for that. And hopefully in a couple of months, I'll be able to attend conferences full time and also contribute to other people's presentation and not just get comments myself. So I apologize for that. But before I start, I'd like to just make a few disclaimers. So first, this is work in progress. As I said, it's the first time I'm presenting this paper. Second, I've reviewed the paper already and I've shortened it, so apologize to the discussant for the very long paper. It's no shorter, and so hopefully it's going to be easier to read. And the last comment I'd like to make is to say that I'll only present one part of the paper here because I only have 20 minutes and I don't think I can go into all the details of all the arguments here. So what's the context of this paper? Basically, it's the context of climate change and carbon taxation and carbon leakage, where we see that more and more countries are adopting carbon pricing instruments, including carbon taxes. There's a wonderful website by the World Bank that highlights how different countries adopt carbon taxes and emission trading schemes. And you can really see that more and more countries are adopting those instruments. And despite the fact that more and more countries are adopting carbon taxes and emission trading schemes, so putting a price on greenhouse gas emissions, there still exist huge disparities between countries' carbon pricing policies. So some countries have very high carbon taxes, some countries have very low carbon taxes or no carbon taxes. And because of that, it's usually considered that there is a risk of carbon leakage. Carbon leakage is defined as the relocation of greenhouse gas emissions from a jurisdiction with ambitious climate mitigation policies, let's say a high carbon tax, to jurisdictions with less ambitious carbon pricing policies and climate mitigation policies in general, let's say no or a very low carbon tax. Or it could also be a no emission trading scheme or an unambitious emission trading scheme. And this relocation of greenhouse gas emissions from one jurisdiction to the next is considered problematic for two main reasons. First, for environmental reasons, because greenhouse gas emissions might increase at the global level due to the relocation of enterprises from one jurisdiction to the next, because it's usually assumed that enterprises will relocate to jurisdictions where there are no environmental standards or no climate-friendly technologies, etc. And it would then mean that the carbon tax implemented by the ambitious country leads to an increase in global emissions. And that's, of course, considered problematic from an environmental point of view. And the other reasons why it's considered problematic is for economic reasons, because no government likes to see enterprises being relocated from his jurisdiction to the next jurisdiction. So from that perspective as well, it's considered to be a problem for the adoption of carbon pricing instruments, including carbon taxes. So what can government do in order to mitigate the risk of carbon leakage? There are usually three options. First option is for countries to refrain from adopting carbon taxes, and it's of course not very good from a climate change perspective. The second option is for countries to exempt enterprises at risk of carbon leakage from the carbon price. And so that's the most traditional answer to the problem of carbon leakage. If you look at the European emission trading scheme, which is the European main instruments to mitigate climate change, enterprises at risk of carbon leakage are still largely exempt from the carbon price. So in this case, they receive free allowances. Countries that have carbon taxes almost always exempt enterprises at risk from the carbon price. And the last option would be for countries to maintain the carbon price signal on carbon intensive enterprises and adopt carbon border adjustment measures on imported products. So you might have heard of the proposal of the European Union to introduce carbon border adjustment measures on a selection of products, including steel, aluminium, iron, etc. So that would be an option that would replace the exemption and preferential regimes that are granted to carbon intensive industries. The problem with that last option is that it's often considered to be incompatible with international trade law. So maybe that's one of the reasons why countries so far have chosen the second option that you see on the slide. And what I do in the paper is to try to challenge this common view. So what you see on the slide is the traditional way of looking at carbon leakage and carbon taxation. I'm trying to challenge that by asking two questions. So the first question I ask is to say, is it really true that disparities between countries' carbon pricing policies necessarily lead to an environmental risk in terms of carbon leakage? So does carbon leakage always constitute an environmental risk? That's the first question I'm asking in the paper. And I'm trying to argue that it's not. And by arguing that it might not be an environmental risk, in some ways, I'm answering the first question that you saw on the slides, namely, is carbon leakage a threat to the adoption of carbon taxes in a negative way, right? I'm saying carbon leakage might not always be a threat to the adoption of carbon taxes, even though governments are trying to present the problem as such. And the second question I'm asking is, if it's true, if my argument is correct, that carbon taxes does not always constitute an environmental risk, what are then the implications in terms of carbon taxation? So what are the implications for the design of carbon taxes? And in this presentation, I'll only look at the first question. So I'll only try to argue that carbon leakage does not always constitute an environmental risk. So to do that, I first would like to present you the two traditional assumptions underlying the concept of carbon leakage and the way we look at carbon leakage in the literature and in the policy debate in general. So the first assumption is that carbon leakage arises due to the absence of international climate change law agreement. So existing agreements can be ignored. For example, the Paris Agreement, those agreements can be ignored because they do not fully harmonize carbon pricing policies. So in this framework, in this context, under this assumption, we will necessarily have jurisdictions with high carbon taxes and jurisdictions with low carbon taxes because there is no harmonizing policies that oblige all states to have the same type of carbon tax measure. So let's imagine that in the green jurisdiction, you have energy intensive enterprises. Those enterprises, because of this disparity, will likely move the activity, or at least they will be encouraged to relocate their activities to the low or no tax jurisdiction, right? So that's the first traditional assumption. The second assumption is the opposite. Namely, it's considered that carbon leakage would not arise under a fully harmonized international climate change law agreement. So imagine that we have an international climate change agreement that requires every single country to have a carbon tax of 75 USD. In that case, if you have carbon intensive enterprises in the green jurisdiction, there is no incentive for them to move to the yellow jurisdiction, right? At least no incentive related to the carbon price. So these are the two traditional assumptions that are being used in the literature and in the policy debate. And I'd like to question those two traditional assumptions because they do not really correspond to the reality, right? We do have international climate change agreements. For example, we have the Paris Agreement, and in my opinion, those agreements should not be ignored. So I'll try to explain why the Paris Agreement should change the way we look at carbon leakage and why the Paris Agreement should influence the characterization of carbon leakage as an environmental problem. So, of course, under the Paris Agreement, we have, I'll just summarize very briefly what the Paris Agreement does, because we are in the tax context, so maybe it's good to just refresh everyone's mind about what's the Paris Agreement. So the Paris Agreement is this agreement that basically require countries to do everything they can to limit global average temperature, or the increase in global average temperature, to maximum 2 degrees Celsius. So that's the goal of the Paris Agreement. And the Paris Agreement does that by giving countries quite a lot of freedom in terms of the type of measures that they should adopt. But there are some principles that guide countries' action. First, there is the principle of common but differentiated responsibility and respective capabilities. So that's a principle that recognizes that developing and least developed countries are not obliged to do as much efforts as developed countries. And the second principle is the principle of progression. So in principle, states are required to regularly upgrade the type of measures that they adopt, so as to make sure that they respect and that they'll manage to achieve the 2 degrees temperature goal set by the Paris Agreement. So under this kind of normative framework, you can imagine that there will be jurisdictions with a high carbon tax and jurisdiction with a low carbon tax, right? Because the low carbon tax jurisdictions are more likely to be developing countries and least developed countries due to the principle of common but differentiated responsibility and respective capabilities. And in this context, it's likely that enterprises in the green countries will have an incentive to relocate their activities to the low tax jurisdiction. But that's part of the framework of the Paris Agreement. That's part of the architecture of the Paris Agreement in some ways. And the reason why I'm trying to argue that this relocation of enterprises from one jurisdiction to the next might not have any environmental effect, or should not be considered problematic from an environmental point of view, is because the Paris Agreement qualifies as a closed system. So what's a closed system? A closed system is a system under which jurisdiction agree to achieve a common goal. And in this case, a common environmental goal. And the textbook example of a closed system is the European Emission Trading Scheme. So I'll try to explain first this concept of closed system, and then I'll apply that concept of closed system to the Paris Agreement in order to convince you that this argument I'm making, namely that carbon leakage might not be problematic from an environmental point of view under the Paris Agreement, is convincing. So as I said, the textbook example of a closed system is the European Emission Trading Scheme. So the European Emission Trading Scheme is the main scheme that we have at the European level to mitigate climate change. It basically sets a cap of the total amount of greenhouse gas emissions that can be generated by certain sectors. For example, the steel sector, the iron sector, the pulp and paper, etc., etc. So there is a maximum number of emissions that can be emitted by those sectors within the European member states. And all those sectors, all the installations of steel, etc., have to grant a number of allowances, emissions allowances that corresponds to the emissions that they generate on a yearly basis. So we can consider that under the European Emission Trading Scheme, the carbon price that applies on those sectors is the carbon price that's determined by the European Emission Trading Scheme. And in that case, enterprises should not be encouraged to move from one jurisdiction to the next because it's the same carbon price everywhere, right? But let's now imagine that there is one member state that wants to adopt, on top of the European Emission Trading Scheme, an additional carbon tax on its enterprises. So let's say Belgium wants to adopt an additional carbon tax on the sectors that are subject to the European Emission Trading Scheme. What will then happen, right? So in that case, it's very likely that enterprises located in the green jurisdiction, in this example, Belgium, might relocate their activities to other member states. And that's, again, what we would call carbon leakage, right? So the additional carbon tax would, one, help the green jurisdictions to further reduce its greenhouse gas emission. It would also lead to carbon leakage that would have some economic impacts on the green jurisdiction, but it would not have any impact on emissions reduction at the European level. And that's what's called internal carbon leakage. Why would it have no impact on the total amount of greenhouse gas emissions being reduced at the EU level? For the simple reasons that there is this cap, right? There is the European cap that's been set by the emission trading scheme. And so if emissions are further reduced in the green jurisdiction, they might increase in other jurisdictions, but they will still remain within the limits that have been set by the European Emission Trading Scheme. Obviously, the Paris Agreement is quite different from the European Emission Trading Scheme. It doesn't require its parties to adopt any kind of carbon pricing instruments. It just, as I said before, set a common goal, namely to make sure that the increase in global average temperature remains within 2 degrees Celsius. And it also establishes a normative framework based on the principle of common but differentiated responsibilities and respective capabilities, and this idea of progression. And in my opinion, those principles and this common goal actually mean that the Paris Agreement should also be described as a closed system. So I'll try to explain why now. So under the Paris Agreement, the carbon price in all those different jurisdictions will be determined by the normative framework of the Paris Agreement. The green jurisdiction, and I'm using green not as a value judgment, right? And just to say that the carbon price will be higher. So the green jurisdictions is likely to be a developed country because they are required to do more efforts than other countries in the context of the Paris Agreement. The yellow jurisdiction is likely to be a developing or least developed countries. And the carbon price might be lower in those jurisdictions. So if that's the case, if you have energy intensive enterprises in the green jurisdiction, there is indeed a risk that those enterprises might relocate their activity to the yellow jurisdiction. It's of course potentially problematic for the green jurisdiction. They will not like it. No, again, as I said in the beginning, no government likes to see its enterprises being relocated to another jurisdiction. But is it an environmental problem? I'm saying it's not, because in principle, when those enterprises relocate their activities to other jurisdictions, they should still be subject to the normative framework of the Paris Agreement and to the common temperature goal of 2 degrees Celsius. So let's imagine that they suddenly start polluting more in the yellow jurisdiction. The yellow jurisdictions probably would have to increase the level of ambition of its carbon pricing policies because of the principle of progression, right? So as long as we remain within this normative framework, in principle, carbon leakage should not qualify as an environmental problem under the Paris Agreement. It should not be considered a threat to the environmental integrity of carbon taxes under the Paris Agreement. So you then ask me, why is it then that carbon leakage is still described as an environmental threat in the literature and in the policy debate, right? Yes, Eduardo, 2 minutes. I'm very close to the end, so that's perfect. So there are 3 main reasons why carbon leakage is still described as such. First answer, the Paris Agreement is inefficient because countries do not comply with the normative framework of the Paris Agreement. So one can thus assume that the traditional assumption that I presented before, namely that no international climate change agreement exists, applies. But if that's true, countries should be very honest about that, and they should recognize that the Paris Agreement doesn't work, and not just say in the policy discourse that they are adopting carbon taxes and carbon leakage prevention measures in order to comply with the Paris Agreement, because that's very much what the policy discourse looks like. The other reasons might be because the Paris Agreement is inefficient, because it's already too late to achieve the temperature goal of 2 degrees Celsius. And in that case, any form of carbon leakage is, of course, problematic. And there are scientific articles that make that argument. So if that's true, again, the Paris Agreement would not function as a closed system, because by definition, a closed system should be closed. And the third reason might be because policymakers are primarily concerned by the economic rather than the environmental consequences of carbon leakage. But in the political discourse, it might be more acceptable to describe their concerns as environmental concerns. And that reason, of course, is very, very problematic because it means that the discourse is not transparent. And it also means that potentially the types of measures that policymakers are adopting in order to mitigate carbon leakage are contrary to the spirit of the Paris Agreement and the principle of common but differentiated responsibility and respective capabilities, which is supposed to protect the interest of developing and least developed countries. So to conclude, the paper challenges the traditional view that carbon leakage is always problematic from an environmental point of view. International climate change law influences the characterization of carbon leakage as an environmental problem. Under the Paris Agreement, carbon leakage might not qualify as an environmental problem. And in the paper, what I'm doing basically is to challenge the traditional sort of bilateral view or dual view that there are 2 solutions to carbon leakage, either unilateral solutions or fully harmonized multilateral solutions. What I'm showing is that not fully harmonized international climate change regimes such as the Paris Agreement might also help mitigate the potential environmental problems that are usually associated with the concept of carbon leakage. So many thanks for your attention. I see that I'm 1 minute late. Sorry for that. And I'm very much looking forward to the comments and the questions. Thank you, Eduardo.
Alice, thank you so much for that. And now I'm delighted to invite Tatiana Falcao to offer her comments. Tatiana is coordinator for carbon pricing at the Coalition of Finance Ministers for Climate Action at the World Bank. Tatiana, over to you. Thank you.
Thank you, Eduardo, and thank you, Alice, for a wonderful paper and for the opportunity to comment on your paper. It's always a pleasure to read one of your papers. They're always super well researched and very to the point. So thank you for giving me the opportunity to do that. Before I start, I should say that it is a 70-page long paper, and therefore I prepared my comments centered on something other than what you presented. So we'll have to reconcile that, but I think it's possible. So I think what I picked up on was the point that follows what you just explained, and that's the legality of border carbon adjustments within the framework of the Paris Agreements. which is actually what I particularly like about this paper, that it provides the legal ground to support the point that has been advocated more widely by developing countries and least developed countries, that the application of a border carbon adjustment towards trading partners is impacting on a country's sovereign rights tax. You make your construct based on the principle of common but differentiated responsibilities that would be legal to export heightened levels of environmental protection via carbon pricing to third states if they are developing countries, because this would mean elevating the level of ambition to third countries and exceeding the voluntary commitment that they have made under the Paris Agreement when self-assigning their nationally determined contributions. So that's the framework under which I am analyzing the arguments. And before I provide further comments or counter arguments to this point, let me just say that I am very sympathetic to the argument. It is a point that I, frequently put forward in my talks to developing countries for a different reason. I put that forward to make them understand why they need to introduce a carbon price domestically, but nevertheless, it is a point that is that they themselves usually raise in order to challenge the suitability of a border carbon adjustment measure. So the assessment of illegality of a border carbon adjustment under the UNFCCC, Kyoto, and Paris, as you say, is greatly justified by the principle of common but differentiated responsibilities. In fact, this is the central argument in the paper to justify what you call an illegality, in that the application of the border carbon adjustment would impose more stringent mitigation commitments on countries, and that these obligations are not voluntary or self-imposed. I consider, however, that there should be other parameters being taken into consideration in assessing the legality of the border carbon adjustment measure. Because even if a border carbon adjustment measure could be considered to be illegal under the Kyoto Protocol, my question to you is whether should we not consider also the fact that lex posterior derogat anteriori, meaning that the Paris Agreement would be the later in time rule. And under an assessment of a later in time rule, all countries would need to meet a self-imposed target that is voluntary, but that is a target. Therefore, there is a common mitigation target for all, and it's just the price that is different. And then there's the question of the carbon price, which is what I'd like to focus next. In the beginning of a paper, you define it as referring to carbon taxes and emissions trading schemes, meaning only it refers only to explicit carbon pricing instruments. It makes sense because there are in fact only two instruments capable of conferring a direct price on carbon. These are the only two instruments capable of conferring a direct price on carbon. However, even if there is no consensus at the level of the international organizations in the literature, it is pretty well established that a carbon price probably means more than just an explicit pricing instrument. It also refers to implicit pricing instruments such as excise taxes on transport and energy, and some even argue that it can refer to regulatory approaches capable of conferring a carbon saving, things like efficiency standards or tradable performance standards. And if these instruments are included within the array of instruments that constitute a carbon price, that would mean that developing countries are in fact already pricing carbon. So the issue would then be to merely equate that into the border carbon adjustment measure and to recognize that the price has already been administered in the country of production in order to receive a corresponding adjustment at the border. And the measure then would only be legal if it goes beyond the mitigation strategy already employed by the country of production. So looking at it from this perspective might mean that the mitigation strategy of the country of production is not lacking after all, it's just under accounted for in the country of consumption. Which brings me to my next point, that assuming that a border carbon adjustment is illegal under the principle of common but differentiated responsibility, there is the follow-up question of to whom is it illegal? I think the paper ought to make further differentiations towards high, middle, and low-income countries. or even towards countries with high, medium, and low levels of environmental mitigation objectives. So if the only criteria privilege is that of the principle of common but differentiated responsibilities, my understanding is that a border carbon adjustment will only be legal towards low income and least developed countries with low voluntary mitigation targets. But border carbon adjustment measures are employed equally towards all trading partners, right? Developed or developing, and not just towards developing countries. And therefore, if we follow that rationale, it would be legal, the border carbon adjustment measure would be legal if employed towards a high income country, not subjected to the principle of common but differentiated responsibility, or a country with a high voluntary mitigation strategy, even if it is a developing country, because the burden to reach net zero fast by that country under those circumstances would be self-imposed. So coming briefly back to the principle one should privilege, like I said, I don't think that the principle of common but differentiated responsibility should be the only criteria. When the Paris Agreement was ratified, there was an acknowledgement from the international community that climate should be a priority action going forward. And over time, we have seen that it should be absorbed under all types of public policies. If we are to live up to the commitment to stop temperature increase beyond 2 degrees centigrades. And so as a result, all the international agreements should be revisited and reinterpreted in light of the current environmental obligations. So to give you an example, which I think is a very strong one of the main arguments that is put forward not to price emissions from flights is the limitation that is currently imposed by the Chicago Convention. However, the Chicago Convention was negotiated before climate even became a consideration. And therefore, in my view, it should be reinterpreted in light of the current environmental obligations. Likewise, the principle of common but differentiated responsibilities is a very old principle that predates any type of climate action and should be reinterpreted in light of environmental crisis which we are under. And so it should not justify inaction. It should allow countries to reach their mitigation outcomes at their own pace, provided that they are acting, but it should actually strive countries to move forward and not just justify inaction. So my suggestion to overcome this barrier would be to, rather than calling border carbon adjustments outright illegal, establish something like a tax sparing provision towards middle and low income countries with low voluntary mitigation outcomes. I thought was very funny, but you could call it anything other than a tax sparing provision because of the weight that the name of the instrument carries with it. But meaning that the country of consumption could, as a result, grant a temporary tax credit towards middle and low income countries that would be reviewed and readjusted periodically in order to increase the level of ambition of those countries in the long run. So a tax sparing solution could help keep the principle of common but differentiated responsibilities intact. But it would actually defeat the environmental goal, which is to achieve a high environmental ambition in the shortest time span. It's a consideration to take into account. I think another point to take into account is that the legality of the border carbon adjustment the article doesn't go into the legality of the border carbon adjustment from a trade perspective. You argue that the Paris Agreement suggests that parties to the Paris Agreement have an absolute right over the emissions generated over their territory, which other parties have a duty to respect. And to justify that, you use the example of Article 6, arguing that the transfer of ITMOs, which are like voluntary credits, between countries is only possible under the assumption that emissions belong to the country where they are generated. However, the jurisprudence of the WTO's appellate body privileges the state of consumption. In fact, it is established jurisprudence in the GATT that a border carbon adjustment measure will only be deemed admissible if the border price equalizes the measure with the domestic charge. So the WTO, contrary to the Paris Agreement, looks towards the country of consumption and not to the country of production to justify legality. And you know, I cannot offer you a solution to that, because that's a point that whenever I describe border carbon adjustment measures, I put forward to the public and the policymakers for them to deal with it themselves. But it is just, these are two premises that would need to be equated somehow. And so, you know, this is a point that, you know, probably should be addressed somehow. And then finally, and this is my last point, I promise, you know well that I am drawn towards multilateral agreements and coordinated measures with an interest to harmonizing international practices. And so I read your section on carbon leakage under an international agreement on a global carbon price, well, with great interest. It goes to show how many good suggestions there are out there with the view of harmonizing practices. However, there's a key instrument which you missed in your bibliography, and that is the proposal for a multilateral carbon tax treaty. I'm sorry, I could not, I could not leave that out. Perhaps the most equitable of all, because it deals with the narrow object of taxation. As you know, this is a developing project, as the proposal is being further expanded as part of a wider project with the ICTD. But amidst, I just thought that amid so much economic literature, which your paper covers brilliantly, it would be nice to also see reflected in there some of the legal doctrine that exists. So congratulations once again on a great paper. I really enjoyed reading it. And you know, I hope these points help you further, you know, I wouldn't say improve it, but just, you know, these points would be considered in the paper. Thank you. You are muted, Eduardo.
Thank you very much, Tatiana Falcao from the World Bank. And now I'm delighted to invite Ian W.H. Parry, who is Principal Environment Fiscal Policy Expert at the IMF. Ian, over to you, please.
Okay, thank you very much. So I just wanted to complement the legal discussion with some economic perspective on how serious is carbon leakage, and are measures like border carbon adjustments warranted. So the economy-wide emissions leakage rate is going to boil down to the product of three key factors. First of all is the fraction of the economy-wide emissions reductions that come from the industrial sector, which is trade exposed relative to other sectors of the economy. Second is the fraction of the emissions reductions in the industrial sector that come from production migrating from the domestic economy to other countries, as opposed to the fraction that comes from reduced emissions intensity of domestic production through adoption of cleaner technologies. And third is the ratio of the emissions intensity of production in trading partners relative to the emissions intensity of domestic production. So let's just look at each of these three factors in a bit more detail. This figure's showing the sectoral decomposition of the emissions reductions under comprehensive carbon pricing for the G20 countries in 2030. So this is, we're assuming carbon prices of $75, $50, $25 per ton for the high, middle and low income countries. And at the bottom, you can see that about 60% of the economy-wide emissions reductions under carbon pricing are coming from the power sector, about 25% on average from the industrial sector, though with some variation, only about 10% in, say, Italy, up to about 40% in Canada, whereas the buildings and transportation sector are only accounting for about 15% of the emissions reduction combined. One reason for that is that these sectors are not using coal, which is has the lowest abatement opportunities relative to gas and oil for the near and medium term. And in addition, on average, the industrial emissions are cut by about 25% below their baseline levels under carbon pricing. The extent to which domestic production will migrate to other countries is going to depend on two key factors. First of all is the increase in domestic production costs relative to any increase in production costs in the foreign economies. And second is the sensitivity of net imports or net exports to increases in domestic production costs. So the figure on the left is showing estimates of the increases in production costs under the same carbon pricing as before for different countries and different products. So we can see that for steel and aluminium, production costs on average increase about 5%, with a range of about 3% to 10%. In the case of cement, the production cost increase is a lot more substantial, between about 15 and 30%. But to a large extent, steel and aluminium are in integrated world markets, whereas that's less the case for cement due to the very high costs of transporting cement per dollar of value. And the figure on the right is indicating the sensitivity of net imports to increases in domestic production costs, shifting up with the domestic supply curve, for the case when the domestic economy is a price taker in world markets, which might be a reasonable approximation for most countries in the case of aluminium and steel. And in this case, when the domestic supply curve shifts up because of higher production costs, we can see that all of the reduction in domestic production is offset by an increase in imports or an increase in foreign production. And the sensitivity of domestic production to higher production costs kind of depends on the steepness of the domestic supply curve. So if the supply elasticity is 1, then a 5% increase in production costs is going to reduce domestic production about 5%. So roughly speaking, in that case, maybe about 1/5 of our 25% reduction in industrial emissions from the previous slide is coming from reduced production, 4/5 is coming from switching to cleaner production technologies. But that can change somewhat if the supply curve is a bit flatter or a bit steeper. And this figure is showing the emissions intensity of production in different industries in different countries. So for example, in the case of the dark blue bars, that's for basic metals, we can see that the emissions intensity in countries like China and India is around about 2 or 3 times the emissions intensity in high-income countries like the US, Canada, and European countries. So this slide is just putting everything together to show illustrative calculations of leakage rates. We're looking at scenarios where either 10%, 25%, or 40% of the economy-wide emissions reduction is coming from the industrial sector. We're looking at cases where the fraction of the reduction in industrial emissions that comes from production migration, as opposed to reductions in the emissions intensity of production, is either 10%, 20%, or 30%. And we're looking at cases where the average emissions intensity of production in your trading partners relative to domestic emissions intensity is either 0.5, 1, 2, or 3. So you can see that for the most part, these leakage rates are really pretty minor, often well below 10%. It's only really in the bottom right-hand corner where we start to see more significant leakage rates. So for leakage to be significant, really requires that quite a substantial portion of the domestic, of the economy-wide emission reduction is coming from the industry sector, 25, 40%, and that the emissions intensity in your trading partners is 2 or 3 times the domestic emissions intensity. But there are 2 reasons why even these calculations of leakage rates might be overstated. One reason is that they're based on the assumption that countries are using carbon pricing to cut industrial emissions, whereas they may use other instruments like non-pricing approaches like tradable emission rate standards, as Canada uses for the industrial sector, or maybe equivalently, countries might tax industrial emissions, but then return the revenues in output subsidies. That's often recommended by some economists. So in the case of carbon pricing, production costs for industries increase for two reasons, indicated by the top left panel. We have a red triangle, that's the area under the marginal abatement cost curve for cutting the emissions intensity of production. But there's also a blue rectangle, that's the charge on their remaining emissions, tax payments or requirements for allowance purchases. If instead we use a non-pricing instrument, like an emission rate standard, then for the average firm, there's no blue rectangle, there's no charge on their remaining emissions. Abatement costs are a bit higher, indicated by the shaded trapezoid. That's because we have to achieve more of the emissions reductions through cutting emissions intensity, because under this approach, we get a smaller reduction in production. So we need to compensate for that. But the figure on the right is just indicating what's the size of the production cost increase under a non-pricing instrument relative to that under carbon pricing. And as you can see, it's a small fraction. It's below 50% of the cost increase under carbon pricing. For emissions reductions are up to 60%. So leakage rates are going to be substantially smaller than indicated in that table if countries are using non-pricing instruments. And then the second reason why these leakage rates may be overstated is what Alice has been discussing, the Paris Agreement. If all countries to the agreement have binding absolute emissions targets, then leakage will be completely eliminated, because any increase in emissions from expanding production in response to leakage has to be offset by emissions cuts elsewhere in the economy. But this is not going to hold up entirely. One reason is that some countries do not have binding emissions targets. In the figure on the right, the white diamonds are indicating the emissions reductions implied by countries' mitigation pledges for 2030. And you can see that in three cases, India, Russia, and Turkey, they're zero. That means that we're projecting these countries will meet their targets in the business as usual case. They do not have binding emissions targets. Another reason is that not all countries have targets for absolute emissions. In particular, two important countries, China and India, have specified their targets in terms of reducing the emissions intensity of GDP. So in their case, it's possible for expanded industrial production to lead to higher absolute emissions, even though they're still satisfying their target for the emissions intensity of GDP. And then thirdly, while some countries may have pledges, but they may not actually implement them. And again, in the figure on the right, the white bars are indicating the shortfall between the emissions reductions required to meet countries' targets and the emissions reductions that are implied by their currently envisioned policies, carbon pricing, renewables targets, electric vehicle penetration, and so on. And you can see that in about 8 countries, they do not have in place sufficient policies to get anywhere close to their mitigation pledges at the moment. So then just finally, are border carbon adjustments warranted? Well, for most countries on leakage grounds, probably not really. Well, there might be odd exceptions like the EU, but for most countries, I think the discussion suggests that it's difficult to justify border carbon adjustments on leakage grounds. Another argument that's been put forward for border carbon adjustments is that they help scale up global mitigation because they're extending carbon pricing beyond the domestic jurisdiction to products from other jurisdictions. But this isn't really very convincing because only a small fraction of nationwide emissions are embodied in traded products. In fact, only 1% of emissions in China and India are embodied in products that they export to the EU. And only about 8 to 10% of their emissions are embodied in products that are exported to the entire world. So if we really want to scale up global mitigation action, we need to have a comprehensive international agreement where pricing is applied to a much broader range of emissions, not just those that are embodied in traded products. And then the third potential reason for border adjustments is that they help address concerns about competitiveness. And then the figure here is illustrating the case where your trading partners have the same emissions intensity as the domestic economy. In that case, applying a border carbon adjustment will increase the costs of imports by the same amount as it increases the domestic production costs. So that neutralizes competitiveness impacts. But if the emissions intensity in trading partners is higher than in the domestic economy, then a border adjustment that's based on emissions factors, country-specific emissions factors, is going to overcompensate the domestic country for competitiveness. So that's a possible argument for countries that are using border adjustments to at least initially base the border adjustment on domestic emissions factors rather than country-specific emissions factors. Thank you. So I'll stop here.
Thank you very much, Ian. Ian W.H. Parry, Principal Environment Fiscal Policy Expert, International Monetary Fund. Now we have some minutes for a Q&A, and I would like to know if there is any question or comment from Africa, Asia, Asia Pacific, the Americas. All right. Now I would like to invite Alice to respond some of the comments. Over to you, Alice. Thank you.
Thank you. But first of all, I'd like to say a big thank you to Tatiana and Jan for the comments. That's very valuable. And I can only agree with the comments probably in the same way as Reuven did before. I'm super grateful. As I said, it's the first time I'm presenting this paper, so I can just take the comment on board and try to improve the piece. Maybe a few things I'd like to react on. First on Tatiana's comments and then on Jan's comments. So one big question you raised, Tatiana, was about the principle of common but differentiated responsibility. So that's this principle in international climate change law that recognizes differences between developing and least developed countries, and whether that principle should be reinterpreted, if I understood correctly, on the basis of the fact that climate change is an absolute priority. It's an interesting idea. I'm not sure I'm convinced by that. So you gave the example of the Chicago Convention, which prevents states from adopting any certain types of taxes on the fuel from the aviation sector. And you said that should be reinterpreted in the light of the fact that climate change is so important. I don't think many countries would accept that argument, many parties to the Chicago Convention, and I suspect that some developed countries would disagree with that argument. And they might, however, agree with a reinterpretation of the principle of common but differentiated responsibility when it's in their advantage. And that's why I'm not so sure that I would be in favor of the reinterpretation of the principle without there being, a UN assembly where all states, including developing and least developed states, can decide on how they want this principle to be reinterpreted. Because climate change is one of the few arena in international law where developing and least developed countries have actually managed to be heard. I think one of the reasons why they have a voice in the talks is because climate change is such a global problem that developed countries have no options but to listen to them, because they know that if they don't listen to some of those countries or all of those countries, climate change will not be solved. And so that's why I would always be very careful with reinterpreting principles that are actually, for once, in favor of least developed and developing countries. But I agree with you. It's an interesting idea, and it certainly should be further explored. So that's one point I wanted to make. The second point related to that is that international climate change law and the Paris Agreement certainly is based on the assumption that generating greenhouse gas emissions is still a positive factor in terms of economic growth. And we could, of course, challenge this assumption, right? We could say that reducing your emissions as much as you can is actually a good thing, because you will promote innovation, you will encourage enterprises to be more climate friendly. You will also reduce all the consequences linked to air pollution, etc., that are associated with climate change. But at the moment, the way the Paris Agreement is structured, it's still based on this idea that having the possibility as a country to emit a certain number of greenhouse gas emission is a positive thing. And so if we accept that assumption, then preventing developing countries and least developed countries from emitting more than developed countries is, I think, problematic. So that's the points on which I wanted to react. And all the other points, I think I have to reflect on them a little further. On Jan's comments, I very much like the fact that you said that the Paris agreements could be linked to, okay, 2 minutes, could be linked to an overstatement of the problem of carbon leakage. And I of course agree with the fact that the Paris agreement is not effective because not all states have binding targets, etc., etc. The paper should be a bit more clear on that, and it should maybe mention that earlier on, because at the moment I put that quite late in the paper, and maybe it sounds like the Paris Agreement is carbon leakage is not a problem at all at the moment, and of course it is, because states do not comply with the Paris Agreement. But what I wanted to do with the paper and this argument is to show that in theory, agreements that do not fully harmonize carbon pricing might still be a solution to the environmental effects associated with carbon leakage. And I think that's an important point to make, because at the moment we in the literature and the policy debate, it's very much based on this double view that either we have unilateral solutions such as carbon border adjustment measures, or we have a fully harmonized international climate change agreement. And I think there is a way in between, and we should recognize that, and states should recognize that, and policymakers should recognize that, because otherwise they just, the debate is just framed in such a way that developing and least developed countries might lose out. And that's wrong, in my opinion. So I have to be clear on that in the introduction of the paper. And so many thanks for the comments. That's very, very helpful. Thank you, Eduardo. Thank you to all the organizers, to the audience once again. And I hope I'll be able to pop in some of the other sessions today and tomorrow, but I can't promise, depending on the crying level of the baby.
Fantastic. Alice Perlot from Oxford, Tatiana Falcao from the World Bank, Jan Parry from the IMF. Thank you very much for such an illuminating conversation on carbon leakage. And now I am more than delighted to hand over my role as chair to Professor Eduardo Traversa. Eduardo is one of the architects of the Global Tax Symposium, and Eduardo is Faculty of Law and Criminology and an Institute of European Studies at the UC Louvain. Now we will take a 5 minutes break, and then Eduardo will be taking over as chair. Thank you very much.
See you after the break.
See you.
It's a pleasure to have the privilege to share a session about not only a topic that is extremely hot at the moment, but with very distinguished guests, old friends and new friends I just made from all parts of the world, as it is in the spirit of this Global Tax Symposium, which is about tax cooperation, but is also about human cooperation and ensuring that there is a circulation of idea, a fair exchange of views between people that share the same world, but maybe not the same local reality. And we'll be hearing a presentation of a paper by Yariv Brauner. Yariv Brauner is a professor at the University of Florida and has been invited as a guest professor a bit everywhere in the world. He's also a good friend that I'm happy to have here. And without further ado, I leave him the floor to present his paper.
All right. So thank you very much, Professor Traversa, for the invitation, and Professor Lee and Kumar for commenting on this paper. Today, I want to talk to you about something that on one hand is very ubiquitous and surrounds us, our lives, as Eduardo just said, at all time. At the same time, it's kind of scarcely discussed in tax scholarship. And I welcome any comments, of course, on this very kind of preliminary draft. Professor Lee, in the introduction, I guess when we discussed it before we came up to the air officially, she said this is about everything, and she, oh, I don't know. Sorry. We're in a break, so nobody should call my, definitely this phone has not rung in the last year. I think this is the regular phone. All right, sorry for this. Without further ado, can you see this switch of the slide? Just one.
Yes, yes.
All right, good. So we are all surrounded by what I will call colloquially the data revolution. We cannot escape the changes that it made to both global and domestic markets, to education, which is our industry, and to everybody's life. And hence, probably the most ubiquitous declaration is that, you know, data is the new oil. We're placing oil as today's most valuable resource. This, however, is not a completely a new observation. Marshall McLuhan's over half a century ago observed that man has been transforming even then from a food gatherer to an information gatherer. So you see the impact is both on the individual and on society. Just as an example, even though we've all experienced this definitely during the pandemic, Professor Shoshana Zuboff from Harvard even went as far as calling it a transformation and warning against this transformation of social control in our society from market capitalism to what she called surveillance capitalism. Naturally, these societal changes impact the law as well. Professor Katarina Pistor queried whether data now not only alters the market, but presents an alternative as a mechanism of control to the markets, and by that to the legal regime that we have today. This is a new means of government. Again, this is not a completely new observations. Years ago, Larry Lessig had a book where he declared that code is law, or the new law. So what does this all mean to our area of tax law? Well, the changes have been relatively small, And mainly, the changes have been ad hoc and were disappearing or were really embedded into the challenges that the international, especially the international tax regime, has been experiencing anyway with the taxation of intangibles. Of course, data is an intangible. And therefore, it was easy to kind of ignore its special treatment if this is a requirement. But in reality, even though we discuss a lot what I would call the base transactions, so we searching on Google and providing whatever information and getting in exchange services from Google, these transactions are not taxed, and there are some really good reasons for not taxing them. It's going to be very difficult, and it is not clear that this is really the transaction that we are affecting. So to put it in a context that will be familiar to some of the people in this audience, definitely, because it is a modernization, I guess, of the Piedras Negras case, which is a 1940s case in the United States. Let's look at a really simplistic situation where we have a radio station located in country R for residents, and then we have the listeners. They're all located in country S for source, and they both listen on the radio, but also a lot of people of them, like many people today, stream the radio broadcast via the internet, and at the same time provide significant amount of information to the corporation. The radio station sells advertisement, as well as data that it collects in the process. And of course, there are transactions between the listeners and the eventual vendors or the buyers of the advertisement. So we see that the only transactions that today really are being taxed are those transactions where money exchanges hands. But there is no the distinct analysis of the entire economic exchange here because of the traditional way that we look at both information and our income tax dominant system. The key here is this original base exchange, if you will, of information for value, which is really difficult to analyze under the income tax. First, because information exchange does not really materialize in an established market. And second, because there are a lot of legal uncertainties about the status of or the legal nature of information. To begin with, we have, we're lawyers, so we have a lot of semantic problems in this context. When we say, when we talk about data, we tend to talk about it very colloquially. And it's difficult to distinguish really data from information, from knowledge. We can define it, and in general, if we think about it more seriously, we can say, okay, data is information encoded. But that might not be enough for immediate application of the law, because, and this is the problem that economists have tackled for a long time. Data, even if we think about it as encoded, isn't simply the collection of the bits. So it's easy to think about it in the computer language as bits, as a binary, a collection of binary choices. The problem with that is that you can know all of these binary choices, but you don't know what it means. And there is essentially an endless possibility of what it means. because of its nature, it is very difficult to commodify and therefore to evaluate information. Information is subject to the law of increasing returns, and therefore markets are very complex. Markets for information are complex and partial. And I claim also that, again, because tax law has generally enfolded information into the discussion of intangibles, that information is a special intangible, data as well, is special intangible, because it's almost an intangible on steroids. Because of its scalability, it is definitely the most non-rivalrous intangible, and its network effects, these are the three common properties of intangibles, are almost infinite, right? We don't really know what anybody can do with whatever piece of information we are discussing. The unique character of information impacts its legal status and the difficulty of establishing its legal status. Most obviously, I think all legal systems avoided, at least until now, to declare property rights in information as a general, in general. This is most easily noticeable in the context of what we call private information, in the base transaction of, we provide information to Google. We all have this feeling that this is our information that we are providing, but a lot of it is not really ours from a legal perspective. This is an old question in legal literature and jurisprudence. What belongs to us? Is our name ours? Is our telephone number ours? Is our address ours? Is the combination of these ours? This is rather a difficult question, again, not a new question. So the way the law had to deal with these issues immediately were at least in two areas. One is privacy law. But know that privacy law does not translate immediately to tax analysis, because we tend to follow in tax law, the income tax follows private law, and privacy does not establish rights and obligations of the source that tax law usually respond to or is based on. And of course, it's kind of complex. We don't have time to elaborate here, but I'll be happy to elaborate in the Q&A if needed. The second area is intellectual property protection. Now, note, intellectual property law is not precisely like property law, and a lot of information or information is one of the types of intangibles that is the least easy to protect under intellectual property law, that we're all familiar, is very limited in its application. And as we said before, the nature of information might not lend itself. We might not want intellectual property law to protect information as much as, a patent, perhaps. A lot of information may be a public good, maybe even a common good. So that really makes the tax debate complex. The fact that it's complex does not mean that this is not at the heart of the international tax debate today, because as we know, now in its two-pillar stage, the BEPS project, really the heart of it were these transactions, these base transactions that I call of consumers vis-a-vis the data giants. Nonetheless, one of the things that I'm trying to get to in this draft is that a lot of the rhetoric on the BEPS project is kind of a retrospective justification. It's not very serious, right? We justify pillar one by the use of on the user participation model, but we don't tax the transaction with the users. We just use a very, very vague, or the OECD is using a very vague benefit style argument for that. The reality is that a lot of information exchange is left untaxed and simply not touched. One approach that was raised in the literature is to view us all as service providers, right? So we are providing services to Google, and Google is providing in exchange services to us. The problem is, of course, that this is a very nice analogy, perhaps. However, it doesn't really fit into the definition of services, you know, in colloquial sense, simple sense. But also, it would be extremely difficult to tax these type of services. How do you value them? It is very expensive. It's very inefficient. We start running after every piece of information someone puts on Google. A lot of information that you provide to many corporations is not even collected. Again, what do you do with that? In the international context, it's not better, because as we've seen, the Pillar 1 style solution is just a proxy and not a very precise one to this kind of idea. Another option is to essentially replace the income tax with the consumption tax. The most common recent example for that is the destination-based cash flow tax. Now, I argue that this is a little bit better than the income tax in the context of data, because we have the destination rules. Now, people say the destination rules are not as simple as you think, and I understand and I know that. However, they are manifestly easier than determining source in the context of the income tax. The destination-based cash flow tax accounts for all cash flows, and it does so on a destination basis. So it's bound to be easier to apply to our situation. But it is less useful in the case of pure data exchanges and in barter transaction, if we wanted to tax all data exchanges. It is easier than VAT to apply because of the valuation superiority, but it still has all the international law issues that doomed it to begin with. Another proposal was to apply some special data taxes. I'm finishing very soon. These are possible. Professor Omri Marian has made recently a proposal to simply tax the flow of data. So this is like the data is the new oil. So let's tax, like an excise tax, tax it directly. Now, the main critique that he received in the beginning was the regressivity critique. I think that's not a particularly good critique, but there are other reasons why I think at least at this point, it's really problematic to apply this taxation. First of all, it's not very good in applying it to what Marian really wants to do, which is to curb the power of the data giants. It is unlikely that any tax that will follow, it will pass our politicians, will do that. And definitely, I don't see it as a serious revenue raiser in the current political climate. The other problem that it's going to be very difficult to write the law in this context. So as I said before, a lot of corporations don't even collect the data. A lot of data is not commercial. How would that achieve legitimacy in the market? I think that's going to be very difficult. Finally, I turn to the formulary taxation solution, so distinguish formulary taxation from formulary apportionment. It seems to me at this point the best among the proposals to deal with it. This is a preliminary stage, of course, a proposal. You know, people say, well, this is an arbitrary system. As I say, I like the fact that it's arbitrary because it eliminates a lot of the pretension that we have in our income. Now, we know that physical presence is not required because of Pillar 1. Formulary taxation avoids the complexity of sourcing and valuation, and it goes around the legal uncertainties, similar to the nation-based cash flow tax. It is less problematic from a legal and legitimacy perspective than the destination backs. It does not solve the problem of pure data exchanges, and perhaps not also of B2C transactions. But again, these are not the main problems that we face in the global setting, even if they are very salient issues. And the most important benefit of it, it is really compatible with the current international tax regime. So we don't need to erect a completely new system. The problem with it, of course, is a political problem, mainly of the residence countries, but this is the same problem that they have with Pillar 1, for example, or I would say even Pillar 2. My time is up. I will stop here. Of course, there's a lot of discussion. Happy to do that during the Q&A. Thank you.
Thank you very much, Yariv. Actually, I remember quite well 2 years ago, Omri Marian presented his draft paper on data during the Global Tax Symposium held virtually in Louvain-la-Neuve. Now I pass the floor to Vinay Kumar Singh, who is Additional Director General at the National Academy of Direct Taxes in India. And I recall that the Global Tax Symposium today, even if it's virtual, is hosted in India. So you are at home, please.
Yeah, thank you so much. So I believe I am audible.
Yes.
Yes. So I think I have 10 minutes, so I'll
10 to 15 minutes. Don't worry.
Okay, I'll begin just straight away. What we have decided between me and Professor Lee, that she will be talking on the later part, including recommendations, and I'll be making some initial observations. And so I'll probably begin right at the go to the very basics and talk something about let me just begin by saying first that it's a very, very in-depth analysis which has been put in the paper. I believe it's still preliminary and a lot of more depth can be added, but definitely a lot of ground has been covered in this. It's very complex issue, no doubt about it. The whole world is struggling with it for the last several years. I had the privilege of being a part of the tax force and digital economy in 2013 when the whole thing began. And so that's how it is. We are still struggling with it, and probably it'll take some long time before we settle. I just want to highlight some of the very, very few basic issues, which I have felt that sometimes make it look even more complex than what it actually is. So, of course, beginning with a kind of a disclaimer that whatever I say is my personal view. Let me move on. And maybe this first slide is not something that I wish to discuss because almost everybody knows it. Only one small point I want to highlight here is that the unfair advantage has been one of the issues which actually gave rise to the whole issue. The problem that the tax neutrality is being violated between MNEs and the domestic enterprises leads to some kind of an unfair advantage, a double jeopardy on the part of domestic enterprises. And ultimately, it's basically an issue of economic jeopardy, which basically, as I'll discuss a little later, which is the real concern here. It's not that the data problem is so complex that it cannot be tackled. So this is, I am probably on a slightly different track than the paper. And let me make it very clear that I do not I have no intention of undermining the issues that have been there in the paper. All of them are there and they have to be addressed, but I'm just trying to, put my emphasis on a kind of a different issue, which is also goes simultaneously and parallel to this whole thing. So when we go for taxation of income, one thing we must always remember that we are not taxing the economic income. So what exactly are we taxing? And here probably it's worthwhile to remember the difference between economic and finance. If we look at very basic economics, there are three factors. The cost is there, marginal cost on the part of supplier, the marginal utility on the part of the consumer, and then the price. Price being the only objective quantifier gives rise to the finance, and that is the basis of almost everything that we do in public economic life. So basically, public economic life is largely public finance, and that is based on price and not economic valuation. That is the first kind of thing we must always remember when we are talking about practical policies that govern taxation. Second part is that tax base, the way we tax it today, is also not financial income, because it is what is being finally calculated through pure financial counting is then adjusted through economic modules. So there's something like depreciation, the taxation of perquisites, and if you look at the IFRS and all that, so much of all this there. So tax base is actually a legal concept. That is something that we need to keep in mind. And this is a very, very important part. So it has never been possible for any tax regime to do a proper valuation of the goods that are leading, or the supplier that is leading to the profits or income. And another thing which we must always remember while talking about valuation, not only of data, but also of any other thing, is that income tax is a tax on profits. It's not a tax on value. It's not a value-added tax. It's a tax on profit. And the profit, basically, in very simple terms, is price minus cost into quantity. And this is a function of demand and supply. So here, both the demand and supply get into picture. So some very, very basic principles, I think, I'm sure everybody knows this, but what am I trying to put forward? So what I'm trying to put forward is tax is a political phenomenon. Tax is not an economic phenomenon. It's not governed by exchange. It is governed by transfers, mandatory transfers backed by authority with a kind of with the power of punishment trait behind it. And that is the Austinian law. I mean, ultimately, that is what works. So what is the difference between a tax which is stable and when a tax seems to be something which requires change, is basically the political bargain. It is the political bargain between the taxpayers and the government, which governs the domestic taxation regime. And it is the bargain between two countries which governs their treaties. So we look at the concept of tax treaties. Why do they become acceptable? It's the political bargain which leads to the win-win situation with both treaty partners getting some fair share of tax. And what is fair is absolutely uncertain. What they perceive as fair is fair. So what they think is that given their political situation, this is what they can possibly get, and that is what they are able to get. Then in all probability, this is my understanding of what they would perceive fair. Unfortunately, when there is a change in that, because of whatever technology revolution can be one, then the whole regime can become unstable. The moment this feeling is there that we are not getting our fair share of tax, whether it is just a perception or whether it's reality, not even matters. So this is a kind of, so maybe, I am kind of side scoping the economic valuation part and just pointing out some of the things which are very, very important when we look at the way tax regimes are formed in real life and in practice. So the stable equilibrium in cases of tax treaties or domestic tax also will be when the two sides of the political bargain are more or less satisfied and they think that making a hue and cry will not be worth it. So what happens with the physical presence? Physical presence has been there for 100 years or so. But then in the technological environment in which it worked, it provided a stable regime. It provided a regime where the two sides of the treaty, the partners, generally had this feeling that they were getting something. They were getting something fairly, and going and trying to get beyond that, trying to get becoming too accurate about what they should get would not be worth it. It will be very difficult. It will be very difficult to prove. It will be very difficult to convince the other partner. And what they're getting is reasonably good. And to that extent, it seems acceptable. So it was probably among one of the simplest solutions which were available. The way we were doing it, physical presence, was that ultimately, if between two jurisdictions, some economic transactions leading to profits has to take place, then a physical presence was generally required when the scales are there. And that is why physical presence was a proxy. Another important thing, if you look at the treaties, Article 5 and Article 7, and Article 5 is just a threshold. It says that if you have a physical presence, then you have the right to taxation. It does not tell you how much can you tax, which is there in Article 7, which talks about attribution. And that is where the things like apportionment and or otherwise the FAR approach and all that, arm's length pricing approach and all come in. So there are two different problems actually. One is the problem of nexus as a threshold. If you do not cross the threshold, do not get any taxing right. That is the real problem. Because when the technological revolution takes place and things are going out of hand, then this feeling develops that I am not getting anything here. This feeling can be generated. And that is what begins to create in the political bargain, which has been the basis of the tax treaties for the last so many years. Now, let me just finally come to the example, which has been there on the page 20 and 21 of the draft paper that we received. And it's an excellent example, very clearly and very simply putting up some of the very real issues. As I hope you are able to make out what is there in the screen. The country R and S, and there is a company X, which is providing a free broadcast to A and so many other people in that country. And it is getting data in turn, which is sells to Y, and then it is able to get some income or profit out of it. Now here, what is happening is that because there's no physical presence, there's no PE, there's no permanent establishment, under the current regime, existing regime, no taxing right is there. So this has been a very big issue. This was probably one of the genesis of the problems and all. Now, what I'm showing this example, and the way I'm trying to put it up, there are two things I would like to just comment upon. The first of them is that, first of all, there has been some discussion in the paper itself about the fact that this is a barter, which it is, in my opinion also. I mean, we can safely say that it's a kind of a barter. If we ignore Y and X transaction and we only look at the XA transaction, it is a barter. Now, whether it is a problem or not, that is something that we have to see. And that is where I like to go back to what I discussed earlier, that what we are taxing is financial income and not economic income. And if that happens, then finance has to somehow come in. So if there is a barter, there could be a valuation issue. But then the valuation issue, whether we normally go for taxation of that kind of a value is the question. And if we look at tax regimes, most of the time we do not go for taxation of that kind of economic value, unless, of course, the value of the two goods that are exchanged in this are clearly marketed, clearly priced, and so well defined that it's possible to say that one of the parties has actually earned a lot of income. So if somebody is, kind of exchanging pebbles with diamonds, yes, definitely there's some income there, and tax regimes will be after their life. But normally, if I'm exchanging oranges with apples, it's very difficult to say who's making income. Here, in a barter, actually, there is an economic income for both the parties. There is probably economic income in every transaction for both the parties. That is why they go for the transaction in the first place. But then what we tax is only is never the consumer surplus. We only tax the producer surplus, and that is the financial profits. So basically, tax regimes are limited by this limitation that they can only tax financial income. And that is because this is the only thing objective which is available. The courts itself will I mean, it will be very difficult to prove before the courts that there is an income otherwise. And so practically it's virtually impossible if the taxing rights are protected by a strong constitutional and legal machinery and framework. This is one issue. Now, so the barters, I'm not sure.
To conclude.
1 minute, just last one notice. So in this case, apart from the barter, there's one more thing I want to point out. And this is that if we exchange the broadcast with wages. So here now there's no more broadcast. Instead of this, X starts giving wages to A, and then it starts collecting data and sharing it with X. Now there's a master-servant relationship, an employee-employer relationship. And in this case, what happens? That there is a physical presence of X in country S. So the question is that a contract for data in lieu of wages, and it does not lead to taxation, but a contract, leads to a fee and taxation, but a contract for broadcast in lieu of data does not lead to. So this is a kind of, I mean, I'm not going to go into the recommendations and the possibilities, but yes, two things I want to point out. That is, of course, one of the law leading to, you know, all wealth inequality and all that. That's, I think we need to look at the law playing its role. And second part is that this part has been, maybe we need to go back to the Wayfair case. And that is something probably also worth considering, cookie nexus. With that, I'll close. Thank you.
Thank you very much. Now I leave the floor to Professor Lee from the University of York, Osgood Law School. She's been visiting professor in several other institutions, but for the sake of time, I won't describe her impressive curriculum. The floor is yours.
You can see my screen of my slides?
Yeah, very well.
Okay, thank you. Thank you, Eduardo, and thanks for inviting me to comment on this excellent preliminary draft paper. When I started researching in this area, that was in the early 1990s, we were talking about taxation of e-commerce. So now we're talking about data revolution and data economy, and it's a fascinating subject. And I appreciate the opportunity of reading this paper. It is so far the best paper on the subject, and I have to congratulate Professor Bronner on doing that. As Mr. Singh mentioned, that I cannot top up his excellent remarks on the political, the legal, the practical challenges and the dimension of international tax law. So I'm not going to. I'm going to just focus on the paper in terms of the recommendations. So I do have a few slides, and this. I'm going to focus on the recommendations part of the paper. In particular, I'm going to talk about some revolutionary potential ideas. The paper, just to set up some key points for my comments. And the data revolution, data economy is a huge subject. It touches on everything, it's ubiquitous, and it touches on every area of life and law. So the paper has done an excellent job laying it out. What I want to tease out is the importance of private law. As the paper says, that the private law is unclear. Who owns what, for how much, what's the value, what is it? So this is the lay of land today. And in terms of taxation, the paper covers consumption tax and some ideas about cash flow tax and taxation of the digital laborers. So I'm going to focus on the international tax of corporations. And I highlight the formulary business taxation idea because it's an idea, I think that's the only idea that will work. So I'm going to focus on that. About international tax, obviously we are focusing on multinational corporations. We're not talking about domestic entities, even though everybody's engaged in data economy, but we're really focusing on the multinationals. And the reality is, as Mr. Singh mentioned, the law is quite limited. We do not have a public international law instrument governing taxation, even though in reality, the data economy by definition is global. So now we see the fundamental dilemma. We have international phenomenon, but we don't have international tax law instrument. And when we zero in on corporate income tax, it is very clear the charging rules are all laid out in national legislation, and bilateral treaties only modify domestic law in terms of the relationship between the two. There are some international norms and standards, but ultimately taxation is a matter of law, and that law is made by national sovereigns, sovereign legislatures. And then the other feature is corporate tax law is really an accessory to private law and market-based transactions. So, and then the nature of international taxation, the way I see it, is really about conflicts of national tax laws. But the big question now is, which country gets the right to tax this new form of economy, and who gets to decide it? At the end of the day, is it just a bundle of money that national governments want to claim and try to tax? We do have some kind of a social contract, if I can use that term to capture what Mr. Singh was saying. Among countries, there's some kind of a deal based on the economic allegiance theory, and recently the value creation principle. So these are the foundations. They are kind of intangibles that sustain the current arrangement among nations about how to share the common corporate income tax base. But there are obvious flaws in the system, as the paper eloquently identifies. Physical presence is a problem. Attribution of profit to a nation, to an entity in a particular jurisdiction is a problem. And as Mr. Singh said, that the simple example in the paper that runs out throughout the paper is an excellent one. It's simple enough to highlight the challenges. You have one person in country X, and the corporation X and Y has a transfer. So, but these problems are not new, and there are new ideas, reform options on the table. And so the BEPS project, BEPS Action 1 was one, and the two-pillar solution. I know Yarob has written a very eloquent paper about the nature of the October 8, 2021 global consensus. What kind of document is that? It is a real consensus. Ultimately, we all know that is a global consensus in a political sense. So it's going back to the theme, is a political arrangement, but it's not nothing. It is actually unprecedented achievement among nations. So what I'm going to conclude my discussions with is, going back to the paper. The paper suggested several models of several ways of conceptualizing the relationship, the data, where value is created, who does what. So I wonder whether the paper can tease out more about the analogy to new oil. Because if it is a new oil, then we all know oil is owned publicly by the government, at least in Canada and in China, the two countries I know a bit more. So if we look at that, then we can look at the data transfers from higher up rather than bottom up, like instead of from the inside out. We can just look at the overall. If Canada owns the oil, Canada can license a corporation to extract and process and tax that. So maybe some resource-based taxation ideas can be borrowed, and in addition to the other approaches mentioned in the paper. But I really want to focus on the formulary business taxation idea because, again, this is not a new idea. Canada, US have used this within the Federation. So Pillar 1 and Pillar 2 are now running with this idea. So to me, this is a regime change. This is revolution. This is not just tinkering with the existing nation-based corporate tax rules, because there's no hope for participating countries to change their corporate tax rules for political, economic, and legal and social moral reasons. Lots of reasons why that would not be happen. So I see the Pillar 1 and Pillar 2 solution as a regime change, a kind of revolutionary, even though it's based on some ideas that we have had, because it's top down. Instead of rely on national laws change, and then you resolve the conflicts between national laws. Now Pillar 1, Pillar 2 is top down, supranational body, whether we think the inclusive framework is a legitimate lawmaking, rulemaking body. It is laying out rules. And so it's top down. And then, as Mr. Singh mentioned, there's a financial income is not really the current regime, but that's what Pillar 1 and Pillar 2 are doing. Forget about legal definition, because there's no way. Private law doesn't define data, doesn't define who owns what data. Now we just say, forget it, move on. So we create a brand new body of international tax law, which is, like a standalone new regime, superimposed on divergent national laws that defer to private law. So now we're saying, forget it, too difficult. And we just use a financial accounting income and forget about the legal fictions. Each corporation is a separate entity. We just look at the group. And then we look at residual profit and use formulary allocation, forget about arm's length principle, transfer pricing, and all of that, transaction by transaction, entity by entity comparison, all of that messiness. So I think, so I would really like to see the paper tease out more about this idea. This is not a brand new idea, but it's in a way it is new. It will be, I know your ability to think deeper than most of us. So it will be really nice to see the final paper maybe turn more attention to this issue. Can this idea that this is a form of formulary allocation method, can it become law? If not the traditional hard law, what are the possible legal instruments? In the first session, there was a mention of the UN initiative. There's a Multilateral Tax Convention for Pillar 1. And many people would argue Pillar 2 may need MTC as well. So it might be exciting to tease out more of this. And of course, politics cannot be avoided. Ruben talked about the US role in shaping the current regime. And now US is playing a different role in this new regime. What is the impact of that? So all of this will be very interesting. And I'm not saying you have to, but I would love to read from you what you write about this. So that's the end of my discussion. Again, thanks for the opportunity. I really enjoyed reading the paper, and best of luck in finalizing it.
Thank you very much, Professor Lee. Maybe I'll pick one or two questions from the audience if there are, and then I'll leave Yariv conclude the session.
I have to stop sharing. I don't, can someone help me? Oh, I found it. Okay. Okay.
Is there anyone would like to make a comment or ask a question? If not, I'll leave Yariv answer to the comments and remarks. Accept the praise also.
Yeah. Thank you. Well, thank you very much for the praise. I don't feel so praised because, as was mentioned, there are still significant holes here, and to some extent, there's a limit that is, the game of articles. You cannot write about everything, and this is truly a Pandora box. I mean, really, I've been working for it for a while, and the problem that each part requires, some deeper thought, and definitely I appreciate this, Professor Lee. It is probably unlikely that this paper can accommodate a prescription, right, for how to do it. Maybe me, maybe others will add to that, and this is not a new idea, of course. Several people on, in here, including yourself, have expressed many ideas in this context. But you're right that I should definitely contextualize it. I've been struggling really most than anything with the beginning. The idea to put the context of the idea of information and data and to package it in a way that will be easily transferable to law in a consistent and maybe deeper, if you will, way, it is not so simple. And I looked at economic literature, so even geniuses of the generation, Nobel Prize winners, have struggled with that. So I kind of feel good about myself not being able to grasp it so quickly. Now, it is true that we could kind of skip it, right? We could kind of ignore the problem, but I think definitely the political discussion that both of you raised show that that would not be a good idea, because it will eventually surface again. I mean, this may be my own position, but as you've seen in the BEPS project, there was this promise of addressing the unfairness, I will agree to this, of the international tax deal. But over time, it was pushed aside, right? And what did they think? That it will not surface again? India is a fantastic example for this. Of course, China as well. And they were not going to just shut up and accept whatever the common denominator decided that the OECD would be, right? So I think this is again something that requires, obviously, not just myself, but other people discussing and going further and deeper into it, because of the pretty certain growth of this revolution, if you will, in industry, and the importance of it to everybody's life. So thank you for the comments. I will definitely incorporate them in the paper, and I apologize that it will not be, for sure, it will not be 100% coverage of the topic, and I hope others will add their points of view to it. Thank you very much, everybody. Thank you, Eduardo, for inviting me.
Thank you. Thank you very much to the participants of this session. So it's clear that data has something to do with tax, but the question is how much it has to do, and what taxation can bring as a solution to regulate data, and probably there is a limit to what taxation can do. And there was a question in the chat also about whether we shouldn't try to create some kind of royalty for the use of the data, as it was a public good. And I think it's a very interesting question, but which is a bit beyond like the taxation of data as such, and the regulation of data, and the private law and public law also treatment of data is also a fundamental question. Thank you very much. And that I pass the chairwomanship to Suranjali for the next session. Let's have a few minutes break. I don't know how many you would allow. 3, 4, 5, and we start again in a few minutes from now. Bye everyone.
Leandro should be here. So I welcome everyone back from talking about taxation and data revolution. Now we're going to look at administration of taxes, and we have a very interesting paper on determinants of taxpayers and tax auditors' acceptance of cooperative automated audits by Paul Brezina. He's at the University of Vienna. He's an assistant pre-doc. As discussants, very interestingly, we have 2 tax practitioners, Leandro Puccioli, who was former tax commissioner of Argentina, and Raul Zambrano, who is the director of technical assistance and technology at Inter-American Center of Tax. So Paul, the floor is yours. Please make your presentation. Thank you.
Thank you, Suranjali. Hello, good afternoon, everyone. Thank you for having us present our paper here. I'm very happy to present the results of a research paper we've been working on for quite some while now. Eva Ebertinger, Maximilian Caesar, and me, all from Vienna University of Economics and Business. I'm going to present the results of our research project on taxpayers and tax auditors' acceptance of cooperative automated tax audits. Now, before we jump into the paper, sorry, just a technical problem. Let me give you some clarification on the process of income tax assessment and tax audit as they are established as of today, and then contrast them to the cooperative automated tax audit process that is subject of our study. Now, the standard process of tax assessment nowadays looks a little bit like this. All businesses are obligated to keep record of their transactions, financial records, to keep books, have accounting data, from which they personally, the businesses, create their annual tax returns, submit them to the authorities on paper or online usually. Then the authorities do manual and statistical analysis of those returns, which only contain aggregate data of the accounting data of the businesses, and draw up the annual tax assessment. At a later point in time, tax authorities might conduct ex post audits, where again they conduct manual and statistical analysis, this time, however, based on the actual accounting data of the businesses. A more recent development in tax assessment and tax audit is the cooperative process, which is aimed at large businesses and is in place in various countries already. The idea is that large businesses discuss all tax-related issues continuously with their respective tax authorities, so they render themselves fully transparent to the tax authorities and receive timely feedback on their tax position. Of course, they also have to keep their books. They also file annual tax returns and receive tax assessments. However, in this case, no ex post tax audits are allowed by tax authorities. As said, this process is aimed at large businesses, and full transparency is exchanged for certainty. Now, let's have a look at the CATA process as we describe it in our research paper. Cooperative automated tax audits, named CATA, are aimed at small, medium, and micro businesses. They have their regular accounting data, but instead of creating annual tax returns, they upload the whole accounting data to the service of the tax authorities on a continuous basis, which is then checked automatically with the help of artificial intelligence and statistical analysis. So again, small businesses, small, medium, and micro businesses render themselves fully transparent. And the tax authorities then come up with the annual tax assessment based on the actual accounting data instead of aggregate data from tax returns prepared by the businesses. Ex post audits might or might not be allowed in this case. This is something we looked into in the project. Again, the idea is that transparency of businesses is exchanged against clarity of the tax position, timely feedback on the tax position. So this seems to be a logical next step in the developments of tax administrations. The last few years have seen major advances in enforcement of tax compliance, but also in trust-related services to taxpayers. Many tax administrations throughout the globe have increased their digitalization efforts using AI-based and algorithmic pre-auditing, statistical pre-auditing of accounting data. Also, data collections and data control were increased by many tax authorities, for instance, with online cash registers. But also the services provided by tax administrations to taxpayers increased, for instance, e-filing and online administrations, but also the provision of substantial and lots of information on tax positions online. Cooperative compliance can also be named as one of these developments. Now, as this trend will continue, kata may prove to be very disruptive because it is a completely new process, unknown to taxpayers and tax auditors so far, which means it will be important to understand under which circumstances the implementation of kata can be successful, especially if kata is designed as a voluntary process and businesses are not obliged to participate. And this is what we assumed in our study. Now, our paper in a nutshell, the research question we addressed was, from the perspective of taxpayers and tax auditors, how will the 4 specific features of kata, being data privacy, algorithm transparency, tax certainty, and independence from tax advisors, affect the acceptance of kata, which is a necessary prerequisite for a successful implementation and actual usage of the system by taxpayers and the support of the tax auditors, trust in and perceived power of tax authorities. Now, I will come to the specific 4 features on the next slide. Let's first look at our dependent variables, acceptance, trust, and power. As kata is a technological process, we operationalized acceptance as the behavioral intention to use the process for the taxpayers and the intention to endorse the implementations for the tax auditors. This was derived from the unified theory of acceptance and usage of technology by Venkatesh et al., which is a theory on technology acceptance, which has shown that behavioral intention is the main influence on actual use of technology, and this is why we think this is suitable for our study. Trust in and power of tax authorities are 2 constructs from the slippery slope framework of tax compliance by Kirchler et al., which has shown that these 2 constructs have substantial influence on tax compliance by taxpayers, which is why we also find them suitable for our study. We conducted an experimental survey and collected answers from 331 business taxpayers and 530 tax auditors. Now, we assess 4 potential features of kata, which aim at improving the service quality and might decrease the perceived power of tax authorities. We identified the 4 features based on prior literature, especially on e-governance acceptance, cooperative compliance, and algorithm aversion, and check the relevance for tax assessment in interviews with representatives of the Austrian tax administrations. Our 4 features are as follows. Data privacy means that after completing the kata process, the uploaded data will be deleted by the authorities. Algorithm transparency means that taxpayers receive information about the algorithms used to check the accounting data. Tax certainty means that after kata is completed, no subsequent conventional tax audit may take place. And independence of tax advisors mean that taxpayers can use kata without engaging the services of a tax advisor. Each of these 4 features was either shown as available or unavailable in the survey to which respondents then answered. What we find are opposing views between taxpayers and tax auditors. Now, taxpayers seem to be interested in the service quality of kata, and they react with increased acceptance and trust, particularly to tax certainty. So if tax certainty was available, they reacted with increased acceptance. They did not perceive a reduction in power of tax authorities. Tax auditors, on the other hand, reacted with disapproval and perceive a substantial reduction in power if tax certainty was shown as available. Our study contributes to the literature on tax compliance, cooperative compliance, tax auditors, algorithm aversion, and e-governance. Let's now have a closer look into the hypothesis development, our research instruments, and the results. For taxpayers, we came up with the hypothesis based on prior literature on e-governance acceptance. Now, we hypothesize that the presence of each of the 4 specific features shown increases acceptance, increases trust in tax authorities, and decreases perceived power of tax administration. For tax auditors, it was somehow different and difficult because there is actually a lack of literature on tax auditors, and the results we could find in literature are somewhat diverging. So we decided not to come up with hypotheses, but to explore the effect of each of the 4 features on acceptance, trust, and power. How did we go about measuring the reactions to kata? Respondents were first shown an introduction and answered some single measures in the questionnaire. Afterwards, they were shown a hypothetical but realistic process as described above. This process contained the 4 features, and each feature was either shown as being available or unavailable on the randomized basis. So in total, there were 16 scenarios respondents could answer to. Each participant could answer up to 5 different rounds and answer to 5 different combinations of the availability or unavailability of the 4 features. The main outcomes we measured were acceptance, which was operationalized as the intention in percent to use for taxpayers or to endorse for tax auditors kata. We call this acceptance. The perceived change in trustworthiness of tax authorities due to kata, we call it trust change, and the perceived change in power of tax authorities due to kata, which was called power change. Here we can see that our participants were mainly male between 20 and 69 years old. For taxpayers, it was mainly business owners answering the questionnaire, in contrast to employees in the tax department. And the sales size varied from taxpayers. We collected the data with the help of the Austrian Ministry of Finance, who distributed the questionnaire among tax auditors, and also with the help of the Chamber of Commerce and the Federation of Austrian Industries, who distributed the questionnaire to taxpayers. In total, we collected 331 Austrian business taxpayers' responses and answers from 530 Austrian tax auditors. On average, taxpayers completed 2.24 rounds, while tax auditors completed 2.42 rounds. This table also shows how many rounds were completed by taxpayers and tax auditors, respectively. Let's have a look at the descriptive results of our study. Here we can see the mean values of acceptance by treatment for taxpayers and tax auditors. And if we look at figure A, we can see that the availability of each of the 4 features positively influenced acceptance of the process. This means if a feature was available, the acceptance was the shown acceptance was higher for taxpayers. In contrast to this, we can see in figure B that for tax auditors, it was the other way around. So the availability of each of the 4 features led to a decreased acceptance of the process. Below, in figures C and D, we can see the mean differences in acceptance by treatment, meaning by each of the 4 features. Now, we used multi-level models to analyze the results of the questionnaires. As I already said, participants could respond to the randomized kata process in up to 5 rounds. So we had to separate the answers, the responses, into global assessment, so the average response between subject variance, and into the relative changes in assessments, meaning the deviation from the participant average, the within subject variance, based on the different rounds the participants answered. Results can thus be seen as ad hoc reactions or global reactions between all of the participants, and within subject, meaning due to comparing the process across rounds by each individual respondent. Variance is evenly distributed within and between participants in our data. We use this multi-level model to come up with level 1 and level 2. Level 1 captures the within participant effects, so the effects of change, effects of comparing different scenarios shown to the participants. Level 2 captures the between participant effects, which is the global effects between all of the participants. Our results confirm the opposing views, which we already had a look at earlier. So taxpayers perceive kata as increasing power of the tax authority and react with acceptance and increased trust only when certain features are included. The most important feature for taxpayers is tax certainty as being available. Tax auditors, on the other hand, perceive kata as decreasing power of the tax authorities and react with disapproval and concerns about reduced power when tax certainty was included. Other features that had significant influence on taxpayers' acceptance were algorithm, transparency, and data privacy. For tax auditors, it was tax certainty, which was definitely the most important aspect. In order to get a better understanding of the results, we also conducted additional tests with alternative dependent variables. So we used benefit being the perceived subjective benefit of kata as dependent variable. We also used correctness of kata's results, change in uncertainty, and change in compliance cost. Here, we found that taxpayers expect data privacy and tax certainty to be beneficial, meaning subjectively beneficial to them. Tax certainty reduces uncertainty and compliance cost, and independence of tax advisors reduced compliance cost, but slightly increased the uncertainty perceived by the taxpayers. Tax auditors, on the other hand, expected algorithm transparency and tax certainty to be beneficial. Tax certainty, as we could already see in the results, was seen to strongly reduce the correctness of kata's results. So this may be in line with the doubts they have. And independence was expected to reduce compliance costs. Of course, we also conducted robustness checks of the main results, including split sample analysis and alternative regression models. We split the sample based on business size, position of the participant in the business, gender, and age. And we could find no significant differences in treatment effects between large and small businesses, between employees and business owners, female and male participants. And we could find some minor differences in the coefficients between younger and older participants, but only for the dependent variable trust change. So there were no differences for power change and for acceptance. Our results thus hold across size, position, gender, and mostly age. When calculating alternative regression models, we did fixed effects regression with data from all rounds and only data from the first 2 rounds, which confirmed our level 1, so our within participant results. We also conducted regressions with average responses from all rounds, which confirm level 2 results, and regressions with data from only the first round, which confirm our level 2 results. This means that our results also hold in different model specifications. Let's come to the conclusion. The taxpayers appear to be mainly interested in service quality. while tax auditors seem to be focusing on potential non-compliance. So taxpayers are interested in trust which is given to them by the tax authorities, by the services they receive from CATA, and they react with increased acceptance. Tax auditors, on the other hand, seem to have doubt or be afraid that the system might be abused by non-compliant taxpayers. This all manifests regarding the role of ex post audits in our study, the tax certainty feature. This means that policymakers should consider that benefits will have to be included into any CATA process implemented in order to achieve acceptance by taxpayers. However, the thoughts and fears of the tax auditors should also be addressed, and there should be safeguards implemented to alleviate the concerns of the tax auditors that the system might be abused. It will also be important to clearly communicate the risks, but also the benefits within the tax authorities as well as with the taxpayers. Again, we contribute to various literature streams with our paper. First, we contribute to the literature streams of novel approaches of tax collections and digitalization efforts, like e-government, e-governance acceptance, which is already a very broad literature stream. We also and the delicate balance of trust and power as determinants of tax compliance based on the slippery slope framework effectively. The rather young literature stream of algorithm aversion, we also contribute to that. And finally, we contribute to the not yet so developed literature stream on opinions and attitudes of taxpayers, but mainly tax auditors when it comes to acceptance of tax audit processes. Our study may also be informative for policymakers for other fields with similar problems or similar targets like insurance, healthcare, or employment, where trust-power balance also plays an important role. So for now, this is it for me. Thank you.
Thank you so much, Paul, for that wonderful presentation. I now invite Mr. Leandro to make his comment on the presentation.
Thank you, Suranjali, and thank you, Paul, for the presentation. As for the ones that don't know me, and apologies for the delay in joining, I am Leandro Cuccioli. I was tax commissioner of Argentina between 2018 and 2020. I read your paper, Paul, and thank you for the presentation. I guess the first thought that it came to mind when I was looking at this is the distinction that exists between systems like the one that you worked on, which is the Austrian system, in which, as I understand, the tax authority doesn't have fiscal or tax invoices, electronic tax invoicing. So the relationship between the taxpayer and the tax authority is one that is built on trust, in a way in which the taxpayer at the end of the year declares his or her income and then fills the tax return, and the invoicing that he or she done over the year is in, it can be any piece of paper, to put it in a way. While in Latin America, and Raul will be able to explore this much in detail because he looks across Latin America and other emerging markets, we've gone through the system of tax electronic invoicing, in which the tax authority already holds the data of the invoices done across the economy. In the case of Argentina, 15 million invoices per day go through the platform of the tax authority, which it creates its own set of complexities. But one thing that it does, which I think it's a crucial part, the crucial trade-off here of CATA, the way it would be for an Austrian taxpayer or a UK taxpayer would be that in exchange for submitting real-time data of my transactions, I'm able to reduce my compliance cost and eventually have some tax certainty around whether, once I've been given a figure of what I need to pay, the tax authority doesn't have the ability then to audit me. So that's the quid pro quo. I give you the data real time. In exchange, you give me lower cost and certainty. And you correctly point out that data privacy may be an issue here. Well, in Latin America and in these systems I was describing, we have crossed that threshold because we already have the data. The same goes for Russia, for example. We have the data of the taxpayers real time because they are uploading both their, all their invoices. So I think that removes one big obstacle, given that you already have the data from the taxpayer. And in fact, in the case of Argentina, we made progress. Unfortunately, this current administration has not progressed, but the ability to, calculate the VAT position of the taxpayer on a monthly basis using the real-time data. So you're already there. I believe that the cost of compliance, which is one of the two missions I believe a tax authority has in terms to lower it, this can be a fantastic tool because for simple taxpayers, you should be able with real-time data to produce accurate estimates of tax positions, which of course the taxpayer can then challenge. I think that in a system like ours, in which we have 35% of tax evasion in VAT, a very high tax evasion, it would be very difficult for us, when I say us, I'm still thinking as a tax authority, to surrender the ability to do ex post audits, given that we know that there is a lot of fraud in the system. So that's the part that, I think that when I was reading your paper, Paul, I was trying to extrapolate what would be the error in a way that we would be making by looking at the Austrian tax ecosystem and how we can extrapolate it to other economies. You identify that in your paper by saying that other industrialized economies probably are in the best position. I feel that in a tax authority in an emerging market in which generally the balance between power and trust is more on the power side, and there is this kind of cat and mouse relationship between taxpayer and tax authority, it would be very hard to comply with this quid pro quo of kata, in which, in exchange for that data, you give tax certainty. It would be very hard to convince the tax auditors in these countries to give that up. At the same time, they already have the data, as I said, in some of these systems. So they are like very close to be able, with the right systems, to provide that kind of kata, that service that kata would provide. But I think it's an interesting, debate. I had it a lot inside Argentina. I got in trouble a lot with the accountants in Argentina because I said, and I still believe, that the simple taxpayers should not have any tax advisor. It should be simple. And of course, in Latin America, the tax advisor works as a data entry with just so many jobs that they need to comply, but that they're low value added because of the complexity of the tax authority. But thank you again. Great contribution. Thank you, Suranjali.
Thank you, Andrew. And now I invite Mr. Raul to make his comment.
Hello and good afternoon over there. Good morning to those in the Americas. Still, well, after the presentation, I read the paper, Paul, and congratulations on the very nice paper. I would say it's always refreshing to take a look at some of the issues we work in terms of tax administration. from the academia point of view, it's always nice to see the trials and the models that you use. So thank you for that and congratulations. I would comment that after Leandro's words, some of my comments might seem repetitive, but anyway, what I would like to comment are some of the key elements that I took out of the paper and the presentation, Paul. So yes. Oh, someone must. Some of the key elements. First is the issue of the acceptance on the side of the taxpayers of a cooperative compliance approach, and we are talking about, as in the paper mentioned, of medium-sized or small taxpayers. And one of the key issues that we take out from the paper is that you mentioned that would be voluntary. It would be a thing that taxpayers would like to opt in or opt out depending on the conditions, and particularly you identify some elements that might make taxpayers approach in a more positive way to that cooperative compliance, like the tax certainty, in such a way that once an audit is concluded, it will not be touched or would not be reassessed, and certainty with, to a lesser extent, as I understood, the two other elements of importance that will be the transparency of the algorithm or the process that will be used during that audit process, and the guarantee that information that will be provided by the taxpayer would be deleted. And I kept thinking from the tax administration point of view, if that can happen, I mean, once you get that information, it might be very difficult to think for the tax administration to say, I will delete and forget of those pieces of information for good. So I was thinking, and that's up to further research, maybe, if that can be translated somehow, not to the deletion or the permanent deletion of that data, but a guarantee that that data would not be used in an improper way, so that only for valid purposes within the tax administration, that information could be used, and very restrictive in terms of who is going to access that. So to protect taxpayers in terms of their privacy, or for companies, their secrets, or who are they selling to, at what prices, or what are they selling. Going back to what already Leandro mentioned, if you think about electronic invoices, that a lot of those invoices are in the hands of the tax administrations all around the world nowadays, those elements, fortunately, have not been exposed into the general public. So it can be assured that tax administrations can have the ability to guarantee the privacy and those. And in terms of the transparency, and we are talking particularly about a small size or mid-sized taxpayers, so the complexities of transfer pricing and particular situations might not touch them. Then many of the situations that should be considered for the computation of tax come directly for the law or for processes that are already well known. So that might be a known approach. So I was thinking some things that might be exposed or put us in a transparency thing for taxpayers to see is, for instance, ratios regarding economic activity or taxpayer size or location that could be public, and that would see if you would be outside and to call it somehow, the comfort zone of the business. And if those ratios are known, a taxpayer could know if it will be probably selected for additional audit or additional inquiries regarding the information. And in terms of what you said, you mentioned also the use of statistics, advanced analytics, and artificial intelligence in that determination. And I was wondering how that could be used in the process. And the conclusion I got from the tax administration perspective is that we have third-party information, a lot of third-party information that comes from many years ago, information from banks, transfer of money, exchange operations in terms of foreign currency, acquisition of assets, buying insurance policies, many sources of information that can be related to what the taxpayers can reflect in their books. And then using statistics and certainly artificial intelligence, you can identify potentially non-compliant situations. And those situations can select cases that would require further inquiries or particular extra work, either for the taxpayer to explain online, or even if that can require when things are looking really, really bad, a visit from a tax administration auditor. So from your paper and the presentation, I was very intrigued by the fact that the potential reduction of cost of not using tax advisors was not something that taxpayers might see very useful. But I was wondering what would be the answer to this type of questions that would the tax advisors give you. So you say there are a number of tax advisors in Austria or anywhere in the world that make a living by helping some taxpayers to prepare their statements and to prepare their income tax returns and file to the tax administration and that kind of work. And some of these way of living might be affected or might consider to be affected. As Leandro mentioned, that some of that might be not a real value added from those professionals, but anyway, they might have a position in that regards. And finally, from your paper, I was wondering that different position from the tax auditors, and I was thinking about that, and I agree probably that comes from the position of the individuals that work as auditors within the tax administration, but not necessarily from the tax administration as a whole, because I see that there is a tremendous potential of increasing the total number of audits that can be executed in a single year. The number of audits that any tax administration can actually perform is determined by the number of auditors that you have, and those resources are scarce. And naturally, that means that the ability to perform an incredibly large number of audits is impossible. So from the tax administration perspective, reaching a number of taxpayers might be very interesting. And I will use the last 7 minutes of my time to make a link of the audit, the automated audit that you're proposing, and something that we currently in tax administration call the pre-filled tax return, which is kind of the same thing but in a different way. The tax administration, using the information that it has, prepare a tax return pre-filled with many fields or all the fields populated, and offer tax administrations offer that to their taxpayers, and taxpayers have the option to accept them or not to accept them. And in that sense, I will try, if you allow me, to use a couple of slides. Let me see if I can do that. Can you confirm that you are?
Yes.
Okay, so these are 2 slides from the Ecuadorian Tax Administration and the Costa Rican Tax Administration. And they show the number of electronic invoicing documents that are arriving every single day. And you would see Ecuador, which is a smaller country than Argentina, has 5-6 million documents per day. And in the last 5 minutes, you see a couple of thousands of documents. And as you see in the other slide from Costa Rica, which is a smaller country than Ecuador, the number of electronic invoices that are arriving to the tax administrations is constant during the day. Of course, it's a lower number during the late night hours or earlier hours in the morning, but you will see that there are documents arriving at 2 a.m., at 3 a.m. So the tax administration is receiving all those documents for transactions with all the details, and those details identify, in the case of VAT, who is the buyer, because that buyer is going to claim that credit for their purposes. And with that, the Chilean tax administration has prepared something that they call the Registry of Purchases and Sales, Registro de Compras y Ventas. And what the tax administration does is they offer the taxpayer to handle the input and output books for VAT. So all the transactions from the invoices they get are recorded. So and the taxpayers have the ability at the end of each month to identify if they are rejecting any of those purchases where they appear as a buyer, or if they are not claiming credit for any particular document because it might not be related to their economic activity. And with that, the Chilean tax administration prepared the tax return, the VAT tax return at the end of the month for all VAT taxpayers. So we have here some of the newspapers' notes of how that has been received by the Chilean taxpayer. This is VAT, as you mentioned in your paper, the automated audit code also applies to other taxes, not only income tax. And of course, this is monthly and is currently accepted by 94% of taxpayers, of VAT taxpayers in Chile. 94% is almost, in my opinion, almost all of them. So it is very nice. So this approach of handling the information and getting services from the tax administration is working. And then is Brazil. Brazil has a system, it's called SPED, Sistema Público de Escrituración Digital, something that would translate as the Public Accounting Information System for the tax administrations in plural, because Brazil is a federation, they have tax responsibilities in terms of at the union, the state level, and the municipalities, and they have what they call ECDs, Escrituración Contable Digital, which include the journals, the general ledger, the daily trial balances of those taxpayers. And those are the numbers of the information they are receiving, but this is not voluntary. Taxpayers have to send that. And with that, they have to add information about employee relationships, who is earning what, the deductions, who is leaving their job post, who are they hiring, and those are the number of returns or declarations in terms of employee that they are filing. And with that, these taxpayers in the years that this started in 2014, the line that says lucro presumido and lucro real are those that are related with the regular income tax of corporations, and those are filed, and they have to match what the daily balances and the ledgers that you have from ECDs. And that is instead of the traditional taxpayer income tax return. So they basically are filing all the accounting data for the tax administration to determine the tax position at the end of the year. And this is from Mexico, and in Mexico in 2018, and you will like this, Paul, they using 48 million information about processes within the tax administration, 617 million tax returns, 10.5 million reports from the accounting of taxpayers, and over 40 billion documents from electronic invoices. They were able to prepare and audit over 2 million taxpayers. Automatically, they prepare all 74 worksheets that are usually used when auditing taxpayers, and when needed, adjustments were determined and notified to taxpayers for them to pay the taxes. So it would be impossible for a tax administration to achieve that number tax audits, electronic tax audits, without that information. And as Leandro mentioned, it might be completely dependent on the system. If you have to put this in a voluntary base, like in Austria, or you are using the powers that the tax administration already has to make it mandatory. But the thing is that it's a structure, a change in the way that things work, and it's very it's looking nice for the future. And to end my comments and to say my last congratulations to you, Paul, I see that this approach in the coming years would not limit to sending information to the tax administration, but even to open the accounting systems so the tax administrations could interoperate with taxpayers in a more close cooperation environment. So that's it, and thank you, Surangeli, Leandro, nice to talking to you and seeing you over the screen, and congratulations again, Paul, and your team on this very nice paper.
Thank you so much, Raul. Some of the points that you made resonated with what I'm thinking in terms of India's experience. One is, of course, destroying the information that exists, perhaps an alternative way of looking at preserving that. And the second one, of course, India has also been looking at invoice matching under its goods and services tax as well, which is mandatory. If there's anyone in the audience who would like to ask a question, please raise your hand, or you can pose your question in the chat box. While we wait for that, Paul, would you like to respond? Oh, Joachim has a question. Please go ahead, Joachim.
Well, I'm aware of time, so just a very brief question. I would have a lot of questions, a highly interesting presentation and discussion, but just one question concerning the design of your cooperative compliance study that you carried out. Now, you said you based it on a realistic design that could be implemented, and that includes algorithm transparency as one means of getting acceptance. And I wonder how realistic that is, because from my knowledge from the German and other tax administration representatives I've talked to, at least the senior figures in tax administration would normally not want their algorithms to be transparent at all, for fear that they will then be manipulated. And here I see an inherent problem, because if you say, well, one of the policy recommendations is to give better safeguards, typically I think tax administration or also tax auditors would say, well, the best safeguard is not to make the algorithm transparent. And that, on the other hand, might imply a significant loss of trust in the procedure and of acceptance of the procedure on the side of taxpayers.
Thank you for the question. The 4 features were preliminarily derived from literature, and we discussed them with officials from the Austrian tax administration. And there we heard, of course, that features like algorithm transparency are in discussion within the tax administrations, but the more progressive forces there think that it will be necessary to give taxpayers it can be discussed how much information about the algorithm, but they are aware that giving information might lead to higher acceptance of such a process. So I think, yes, there is a discussion going on within the administration, but it's not complete. It's not that they completely disagree to have a feature like that.
If there's anyone else with a question, we still have some time. Paul, would you like to make any other comments regarding the comments made by Leandro or Raul? Or
can I ask a question?
Go ahead, Leandro. Please do.
Paul, based on what you heard, how would you, if you were to, because I think it's very interesting, there is research, if you were to do a version 2.0 that also includes other tax ecosystems like the ones we've been describing, how would you go about adapting your research, or what would be the next iteration, just to be able to accommodate some of these more diverse systems?
Well, I think one additional way what to analyze would be if the introduction would not be voluntary, but each taxpayer would have to use a system like that, and to analyze how results change. In that case, as you described, there are many jurisdictions where fiscal invoices are already in place and have to be used, which is small but is an aspect of the kata system as presented, I would say, or very similar to it. But also, of course, the study could be conducted in other countries where digitalization is already further. I mean, as I understood, Raul, in Mexico, for instance, or in Chile, a lot of data is already gathered and people are forced to transmit that data. So it would be interesting to see how people would react there with acceptance, because I'm not aware of any study that analyzed acceptance of such measures in countries like Brazil, Mexico, or Chile.
Paul, we have one more question from Dr. Mukherjee. You can please pose your question, Paul.
Yeah, thank you, Suranjali, and I hope I am audible to all of you. My question is that related to what Paul has studied, mainly the small and medium enterprises. What I found in India or any other developing countries is that the cost of adoption of any ICT kind of infrastructure like computer, internet, broadband, and also accounting system integration with the tax administration. So do you think that it will reduce the compliance cost, or it will increase the, say, capital cost of compliance? Maybe the revenue cost may go down, but the capital cost, one-time cost of adoption, this kind of infrastructure will increase. So that is my question. And the second issue is that it is not new that in our GST system, as Suranjali has already pointed out, our system is that we have large number of enterprises. It is very big, and the distribution of the range is very high. So the thing is that we are also doing the real-time matching invoice and other things. But of course, there is also need the annual audit, which will be carried out by either by the state tax administration or the federal tax administration. So is it that the continuous information capturing and transferring to the tax administration can get rid of annual audit function of the tax administration? Thank you.
Thank you for the question. Sorry, my internet was just slow for a moment. So let's start with the first question. The one-time cost of implementation, we didn't ask specifically for that, but we conducted an additional test where we asked for compliance cost reduction, and this might be included in there to the answers. So as people, the taxpayers thought it would reduce a compliance cost, we could interpret that they think the one-time cost they have for implementing a system like that are lower than the cost of tax audits at certain later times. But we cannot say more about this from the results that we received, actually. And the second thing, if such a continuous transmission of information to the tax authorities, if that could actually not prevent, but yeah, future tax audits, and it can be used instead of future tax audits. The tax auditors in our study, they think that this should not be done because apparently they are afraid that the system might be abused and the power for tax enforcement would be reduced. Taxpayers, on the other hand, see this as a very necessary step in order to accept the process. So I think the views are very opposing here, and if enough safeguards are incorporated in the system, it might actually be that a system like the cooperative automated tax audits as described really is done instead of ex post tax audits.
Thank you so much, Paul. And with that, I think we've come to an end to the session. And
so
would
thank
you like to say something?
Yes, thank you to the discussant. Thank you for the very helpful comments and the insights into the world of tax administrations of other countries. It is very, very interesting to hear how other countries operate, and it is very different to how the Austrian tax administration works. So thank you very much appreciated your comments and discussion. And Suranjali, thank you for hosting.
Thank you, Paul.
Thank you, Suranjali,
Paul,
and congratulations once again, Paul.
Thank you very much.
Thank you.
Thank you, Leandro, for joining. And now we're going to go into the next session with a 3-minute break, where I give it back to Eduardo, a wonderful chair of the panel for today. And we're going to be talking a lot about income taxes now. So over to you, Eduardo.
Okay, thank you. So 3-4 minutes break. Hello. Hello, everyone. Good morning, good afternoon, good evening, good night. It's really great to be able to finish this first session of the Global Tax Symposium 2022 with such a diverse panel from all over the world discussing global trends in tax policy. We will try to cover a wide range of issues, but the idea will be to focus on which type of new taxes could arise, and especially focusing on wealth, capital gains, high net worth individuals, mobile workers, and so on. For this panel, I have the pleasure to welcome, as I said, a tax expert from very different places and backgrounds. So we have Shafiq Hebbouz, who works for the IMF at the Fiscal Affairs Department, Professor Henk Voording from Leiden University in the Netherlands. We've got Rajat Bansal, who's Principal Commissioner of Income Tax in India, Saturnina Moreno-Gonzalez, Professor of Tax and Financial Law at UCLM and in Spain, and finally Emeka Nkwanko from the African Tax Administration Forum. So the first introductory question that I would like to ask to everyone basically is that do you see a trend in your region of raising existing taxes, and which reason do you see for that, or on the contrary, the current times do not seem to require a raise in national revenues? So who wants to start? Maybe Shafiq, for a global perspective.
Thank you, and hello everyone. Thank you for having me. Yeah, I would like to answer your question by making the following observations. I think mobilizing revenue is a top objective for many countries, given the existing situations and the public finances in many countries. Then the question is how to raise revenue in the least distortive way and most equitable way at the same time. And in making a point for progressive taxations, I would like to start with a general guiding principle we would like to raise taxes in the least distortive way. So that means, this is basically calling for making the best use of a VAT and recurrent property taxes, use the revenue to redistribute income in the most targeted way. However, that arguments need to be appended with one more element. When we use the spending and the best targeted measure, these usually are good in reaching those at the lower segment of the income distribution. So these targeted spending measures are very useful in alleviating poverty, and reaching achieving our redistributive objectives at the low income segment of the distribution. But then the question becomes, how can we reach the top of the income distribution? And that's why we need an increased average tax rate in a way to increase the inclusiveness of the system and increase progressivity of the system. Because there is no other way to reach those at the top of the income distributions except for tax. But then my question is, do we really need a new tax? Or maybe we can make a better use of existing taxes. And here, the issue is not only raising the rate in order to raise revenue, but when it comes to taxing at the top of the distributions, we need to look how is capital income taxed. In many countries, we have situations where different sources of capital income are taxed differently. Capital gains is taxed differently from dividends, are taxed differently from income interest income. And that opens arbitrage opportunities. So we need to close such loopholes. We need to think how are closely held businesses taxed. So there is a whole set of issues that need to be addressed to improve the taxation of capital income and hence progressivity and hence raising revenue, maybe before we start thinking of new taxes, although introducing new taxes could be also an option in many countries. I'll stop here and give the floor to the other.
We'll go back to capital taxation later on, but I would like to ask the other participants whether there is a trend toward increasing existing taxes, creating new taxes, also because for a long time now, it's been some decades that a focus when focusing on the revenue raising capacity of taxes, focus was led more on indirect taxation and on VAT, on introducing VAT. Those were recommendations from international organizations. Also in Europe, there was a strong focus on the revenue raising capacity of indirect taxes. And therefore, I would like to hear maybe, I don't know, in Rajat Bansal on what's the tendency in India when it comes to raising the revenues of the states and the provinces.
So thank you, Eduardo. Thank you for inviting me for this discussion, and I'm very happy to be a part of it. First of all, because I am working for the government of India, I like to clarify that whatever I say is purely in my personal capacity, and it does not reflect the views of government of India in any manner. Okay. And yes, secondly, I am working for the income tax wing of the government, and therefore here we are dealing with different taxes in different departments. So I am dealing with the central government's or federal government's income tax administration. And so pardon me if I do not directly address what you asked, Eduardo. I will tell you about my view on the scope of raising income taxes in India. And here I am distinguishing between income taxes and corporate taxes. I am focusing on personal income taxes. What is the scope of raising those? So there also, as of now, there is no new tax that is being contemplated or has been imposed in recent years. And it is the normal income tax that is levied on individuals and other entities, which is constituting the income tax. In India, around less than 50% of the total direct tax collection is through the income tax. And the rates are at a level that I do not see much scope of raising them. And because the taxes can be, the total collection can be increased in two manners possibly. One is the raising the rates of tax, and secondly is the increasing the tax base. Rates, as I said, are at a level that I do not see much scope of raising them. Maybe there is a scope of slightly lowering them rather than raising them. Now, on the tax GDP ratio of India has been direct tax collection to the gross domestic product ratio has been around 6%, which is low as compared to the developed economies in OECD and other countries. 1/3 of the GDP is outside the tax net, that is the agricultural income. So that also has to be factored in. Even then, it is slightly on the lower side. So definitely one can think that one can clearly see there is a scope of raising income taxes. The population and the number compared the taxpayers, number of taxpayers compared to the population are also low. So that also is indicative of scope of raising the income taxes. So then essentially what I'm trying to say is that the income taxes raised can be through increasing the tax base. And in that direction, several measures are being taken. For instance, I mean, now the Revenue Department is becoming more and more information driven, and they are taking steps to capture information from various sources and put it to the taxpayers whom they pertain to make them voluntarily comply with their obligations. So that is yielding dividends, and that is yielding results. And year after year, the collections are growing, but the tax GDP ratio is still not at a level that one would want them to be. So to sum up, I would say that there are efforts to raise taxes through the existing mechanism with not a radical change or scheme in the offing at the moment.
Okay, so the idea is to keep the existing structure and try to have a better compliance rate, a larger number of compliant taxpayers, and a better information exchange.
Absolutely. You have summarized it absolutely correct.
Okay, thank you. I turn now to our African colleague. What is the tendency in the African countries you know best about the possibility of raising income tax as a stable source of tax revenue? Do you have any comment?
All right. Yeah. Thank you, Eduardo. I think similar to the previous speakers, in terms of income tax, we've not seen a huge move towards some sort of increase in terms of rates or major changes. Again, this is understanding post-COVID, what the environment seems like, and the burden already on taxpayers are the fooling around. But in a few jurisdictions where we've seen some sort of introduction of the government trying to introduce some sort of transactional tax, whether it's an e-levy or on phone calls or other, technology services, we've seen the resistance towards that from different quarters of the government even, and then the people. So what you find more is similar to what is shared about India and what Shafiq shared is people are looking more about how do we improve compliance? How do we deepen compliance and the base versus introducing new tax? And the major go-to for most jurisdictions now is the technology aspect, automating processes for ease of compliance, both for administration purposes, inward-facing and outward-facing for tax payers. And then data has become a major thing. How do you harness and collect data from third party? And then how do you use that internally for CRM, for your compliance risk management, for example, across all tax types? Because usually, and I'll reference this to VAT also, because you have a situation where we say VAT contributes about 30 to 29%, for example, in the jurisdiction. But what we don't factor in that cycle is how much of that is refund that wasn't done within an ineffective system. So again, the idea is how do we improve the system where we can still make those refunds and then still have an incremental value to the VAT collection, the nominal value and real value of VAT collected. So most of the focus is on improving compliance, technology data, and then capacity building. end of the day. Because even if you introduce the new tax or major policy shifts, the question will still be, is there the capacity to implement if the existing ones are not being implemented effectively? So yeah, similar to that, the focus is more on deepening compliance, basically. Thank you.
Okay, thank you. We'll go back to also the capacity building and complexity of taxation, because that's a real issue. Maybe Saturnina, what is your viewpoint on increasing tax revenue, let's say?
Bad news or good news, it depends. Fiscal policy in Spain goes in both directions. On the one hand, income taxes have been increased, but on the other hand, new taxes on windfall profits or extraordinary profits are being created at this moment. To understand the scope of the latest income tax reform in Spain, I think it's important to point out that Spain is one of the EU countries with a greater financial imbalance. So the situation can produce a serious risk of financial sustainability when the European institutions lift the temporary suspension of fiscal rules. So that's the first point to keep in mind. And the second one is then that since 2008 crisis, inequality and wealth concentration have increased markedly in Spain. That's why since 2020, several tax reforms have been carried out in order to making balanced economic growth compatible with an increase in tax revenues that strengthens the welfare state and reduce inequalities. For instance, regarding personal income tax, from the beginning of 2021, a higher tax rate has been established in the for the highest tax basis in both cases, both in the general tax base and in the savings tax base. And regarding corporate income tax, I would like to highlight two of the most relevant changes in recent years. The first one concerns the correction of international double taxation of dividends and capital gains through the exemption method. From the beginning of 2021, the exemption method is limited to 95%, which means that 5% of the dividends and capital gains are now taxed as portfolio management expenses. And the second one is that from the beginning of 2022, we have in Spain a minimum corporate income tax of 15% of the tax base in the corporate income tax. For those taxpayers with a net turnover equal to or greater than 20 million euros, or who pay corporate income tax under the consolidated tax regime. That means that as the result of the application of different deductions, it will not be possible to reduce tax liability below this amount. So these are some of the reforms, especially important in my view, in personal income tax and corporate income tax. If you want, I speak about the new taxes. I can do it now or when you want.
We can do that later. It's true that the European Union has this specific feature of having a kind of supranational control, although it has been a bit, let's say, put into parentheses COVID, but the supranational control of the financial policies of the states and of budgetary policy. And so now there is will come some kind of pressure to have balanced budgets and therefore increase taxes when necessary, plus the issue also of quality. I turn now that to colleague Vording because Saturnina Moreno mentioned corporate taxes. So the Netherlands are a country that is known for having used for a long time corporate tax as an instrument of economic foreign policy.
That's right.
Therefore, trying to lower when possible in order to be attractive. Is this tendency still existing, or is there?
No. I think it has turned almost 180 degrees in an attempt to improve our reputation in the field of international tax planning. And nowadays, actually, plans to further reduce corporate income tax rates have been postponed to make the budgetary space for comforting low-income people. As to personal income tax issues, we do have an issue with net wealth taxation. Our system has been subject to a series of court judgments, which now means that we have to find a new system more in the field of capital gains taxation. And we do have the issue that Shafiq mentioned of closely held corporations, where the average tax burden is quite low. In fact, I think while the current government is not intending to tax high-income people at higher rates or make tax more effective there, there is this report of last year that addresses an issue that I think is common to many countries. It shows that when you look at average tax burden, overall tax burden, including VAT, etc., overall tax burden on the household level, that overall tax burden is quite stable over the full range of incomes, 40% in the Netherlands, 40%. But it starts to decline at the top 1%, and it's actually only 20% when you arrive at the top 0.1%. So the few most wealthy families in the Netherlands face a tax burden that's half the amount of the normal household. So that's an issue of effectiveness at the top. And I think that's an important one in all the topics that we are raising here. Because I think that many countries have a problem there.
Yes, it's the situation in the Netherlands is interesting, and probably it's to a certain extent is a reflection of a global trend that the government has decided to postpone, if not stop, the project of lowering again the corporate tax. And at the same time, there is this issue of a constitutional law issue as regards the old system of taxation of, income from capital, and the issue of inequality. So those three things, like a halt in using, and that's probably also a consequence of what's going on at the international level, the corporate tax competition. Do you feel that, and it's an open question to anyone, that what's going on at the international level, let's say, allows country to use more corporate tax as a revenue-raising instrument than simply an instrument to attract foreign investment? Who has some thoughts about it or not? Can be. I don't know.
I would be curious whether that's a question to the other members of the panel, whether you're actually already contemplating to develop something like a qualifying domestic minimum top-up tax. So the thing in Pillar 2 that would allow source countries to actually tax the gap found under Pillar 2 instead of giving the revenue over to the resident countries under the income inclusion rule. So is there any development in this field of qualifying minimum taxes?
Yeah, that's an interesting trend, which would allow countries that do not tax enough corporation in individual cases to raise the tax in order to make sure that they comply with the minimum level of 15%. I'm wondering, well, it's difficult to say that there is a continental trend, but from an African perspective, are corporate taxes like an instrument that is contemplated in order to raise the revenues, or it's not the most adequate or the preferred instrument of African governments?
All right. I think at some point, I don't know who was speaking that referenced the idea of VAT. So if I'm to say preferred instrument, that would be, but in terms of companies' income tax, speaking from the perspective at continental level at ITAF, it will differ across countries, right? Because looking at rates, you will see how that works, and then the issue of tax holidays and tax incentives and how it's used by countries. So this would differ across jurisdictions. But what is currently happening is also within the international conversation and the conversation around IFS, international tax and all. You're having more countries thinking about and development partners helping countries look at the idea of tax expenditures and these incentives to evaluate how will I say how profitable or how effective they are for the intended FDI or driving investments that they're supposed to versus the trade-off in terms of revenue across jurisdictions. But similar to what was mentioned for Netherlands, at the ITAF level, also looking at the Pillar 2, currently, the cross-border technical committee of ITAF also is working with countries to develop some sort of guide on how to draft the domestic minimum, domestic qualified minimum tax top-up, right? To make sure there's some sort of consistency and countries understand the issue on how to address that. But I think it's the idea looking at where for African jurisdictions where we are coming from is to strike that balance where you don't have the negative tax competition, but you're still able to attract enough FDI considering where we are in terms of development and economic situation. So it's trying to find that balance at the end of the day.
Sure, interesting.
Yes. Yes, it's true that not all countries are in the same situation when it comes to access to capital or foreign investment, and the international consensus will have an impact certainly on the position of the respective position of the various countries, and we'll have to wait a bit to understand what will be that impact. When it comes to, so we addressed that too, when it comes to revenue raising capacity of income tax system, in between like personal and corporate income tax, we've got this gray zone of let's say income from capital that is sometimes taxable in the hands of the corporation, sometimes tax in the hands of the people, or shareholders, stakeholders, depending on the type of income they receive from the corporation. Well, is this a phenomenon that attracts the attention of tax authorities? So Engvalding mentioned and a closely held corporation, but at the same time is a discussion on taxation of capital gains, a discussion about the scope of application of corporate taxes, and to a certain extent also of wealth taxation. Is this something that your respective countries are trying to tackle? So flows of revenues between companies and individuals. Who wants to?
Perhaps maybe I can take a first go on your question. I mean, I think it is a very important topic. We need to be better at taxing capital income in general. And I think it's an issue that is at the top of the list in many countries, developing and developed countries. So when it comes to the personal income tax in general, which will include not only taxation on labor, but also taxation on capital at the individual level. In advanced economies, in many advanced economies, it's slightly more than 20% of total revenues. But in some developing countries, it's less than 10% of total revenue. So we see there is a scope to mobilize revenue on the personal income tax side. And then what is important really is, as I mentioned, to be better at taxing at the top of the income distribution. So why are we seeing some issues here? So there are two broad reasons. One is there is policy design issues that basically effectively give reduced tax rates for capital income, or opens a loophole and arbitrage opportunities. And these need to be addressed. That's one kind of broad issue. And I'm happy to elaborate on that later. The second kind of set of issues, or the second reason, is in enforcement and tax compliance at the top of the income distribution. So we know in many countries, the top 1% own about 40% of the wealth. So wealth and income is highly concentrated at the top of the distribution. Yet some evidence suggests that those top 1% may evade and / avoid maybe 20%, 25% of their income, depending on the countries. What we can see now is, however, some opportunities to improve enforcement at the top of the income distributions because of exchange of information, because of making informations more available to tax administrations. So this is a significant step forward, which will enable better taxations at the top. But at the same time, it requires also using the information in the best way. So it's not only sharing information, which is fundamental and very important, but also we need to use the information actively in our risk analysis. And then third, I would like to mention that within this issue of information, we need to have reliable information, and that speaks for having kind of beneficial ownership registries so that we can go through, penetrate through the veil of secrecy and understand who is the natural person that is owning a trust or a shell company, especially those complicated structures that are typically structured offshore for the tax administration. So so in short, there are a set of policy issues, there is a set of administrative issues to improve the taxations of capital income at the top.
Mm-hmm. Yes, very interesting. I would like to ask Rajat Bansal, in India, the fact that there are very mobile taxpayer, or that capital could be very mobile, is it an issue? Is there a specific focus on potential capital flight or risk of people, taxpayer leaving the country, and that the tax authorities are not able anymore to trace their income? Is it a preoccupation of the Indian tax authority, those mobile worker, mobile capital issues?
No, I don't think there is any such very visible or perceptible phenomena of very mobile taxpayers. I don't know if you are referring to the recent change in work systems, or due to which there are a lot of mobile workers. I mean, due to the digitalization, people are able to work from where they want to, and employers also have the choice to recruit people from anywhere. So on those counts, yes, there may be mobility amongst the employees, and they are working in different places. But India has a lot of skilled manpower, and probably due to that, since people will prefer to work from here, quite a few of them will prefer to work from here. So probably the flow will be inward due to this phenomena, and the employees will be working from here. And since employment income will be taxed where the employment is exercised, so that will contribute positively to the personal income tax. rather than the other way. And probably the other thing you were referring to were capital being, I couldn't exactly follow, but probably you were referring to capital being kept overseas, and therefore
yes, exactly.
yeah. So,
By Indian residents kept overseas in some islands near the Indian
yes,
Peninsula. Yeah.
So the work done in the area of exchange of information is has been really helpful. Globally, what has been done to improve the exchange of information has really cracked on that kind of phenomena of stashing the wealth abroad, or hidden wealth or unaccounted wealth, if you're referring to that. And yes, there are disclosures one after other by various international bodies which are engaged in this thing, but still, I would say that those are things of few years back, and going forward, this phenomena I think is shrinking or reducing because of improvement in exchange of information. And also automatic exchange of information is now really picked up. So, and more countries are member of that as well. So therefore, this phenomena is, according to my understanding, is going down. The graph is down rather than going up.
It's our impression too, but it's good to know that that kind of global trends benefits almost everyone, of almost all the countries. I wanted maybe to ask Saturnina or Emeka if you had something to add on this enhancing.
I would like to add. I would like to add that the taxation of capital gains in Spain is especially debated in the field of personal income tax, because as you know, in Spain, we have a dual personal income tax with two tax bases, general tax base and saving tax base, and capital gains with that derive from the transfer of rights or assets are part of the saving tax base. And the question is that the saving tax base has less progressivity than the general tax base. For instance, at the moment for savings tax base above 200,000 euros, the tax rate is 26%, whereas the highest tax base in general tax base is has to pay a maximum marginal tax rate of 47%. So the difference is quite big, and some expert groups from time to time consider that we should reflect about the need to develop a new personal income tax with an unique tax base. So this is a question, it's an important question. And the second one is that we in Spain, we also have exit taxes in income and corporate income tax to tax unreleased capital gains. So yes, of course, it's a question important for our tax administration.
Yes. To add an element, I'm in a country in Belgium when there is a 0% capital gains tax, absence of taxation, and it's very hard to defend that, like from a theoretical perspective, but it's strongly anchored in the tax culture here in Belgium. It's complicated to have things move forward, and it's also some things that from an international perspective appear a bit awkward. Then when you enter into the tax culture of the single countries, you realize that they're deeply rooted in it, despite manifest inequality that it carries. Emeka, yeah, you wanted to add something?
I think from the personal income tax perspective, I agree with the impact of the EUI on two levels. I think taxpayers knowing that now that capability is there, kind of, I would call it the fear factor that pushes taxpayers to try to comply more, knowing there's the possibility for that information to come across. And what we've seen in some jurisdictions is you find that jurisdictions that actually have some sort of framework or strategy on the use of the information received do better in getting some results from it, where part of the EUI plan is beyond passing through the global forum review phases and having the infrastructure, but having a clear plan on how that data is fed into the regular domestic tax operations, who uses it and for what, and how you monitor and evaluate the impacts. There's been jurisdictions that reported returns from using EUI information in that respect. But there is also the bigger issue of political will, because you find out that some of the, again, when we talk of the higher income level category, again, within Africa, these are usually probably influential or politically exposed people, or people that could influence decisions. So the question is also, is there the political will to actually go and enforce and get these taxes, even if the capacity is there? I mean, we talk about all the Pandora papers that have been leaked, but the question is what has been done with those information on the tax aspect. So we find there's the issue of the political will there. But you also find jurisdictions where, case in point is Uganda, where a special unit had been set up for high net worth individuals in terms of providing tax services to them. And that actually showed about 100% increase in filings and collection from high net worths. But this was as at 2015 also. But you see that, again, with such strategies and where the will is to do that, there's a yield. And in terms of capital gains, I think for Africa is a bit dimensional to think about what is the capital assets basically within here. So you don't have strong financial markets per se or equity markets in Africa. So you go back to tangible assets, which is usually real estate. Now, what would I have these real estates? Some are held within entities that are set up for that purpose specifically, as if they trade, but it's the same set of people within that, right? And then that puts you automatically within the purview of a company's income tax, for example, if the jurisdiction where that is treated different. And even when the transfers happen, I think I'll go back to the issue of, again, the exposure and enforcement. And then the issue of different agencies not being integrated to know, because you find in some jurisdictions, capital gains is done at the local level. It could be at the state or local government level, where this has to do with real estate, where probably the Land Act or issues around real estate is managed within the state level. But the question there is the tax authority, do you have access to the information to know when these transactions happen, when these registrations happen or transfers? Or has it been built within the legislative framework or policy, or even the operations where payment of the tax is part of the completion of the process? For example, because I'm talking about where the transaction has happened, a transfer has happened for the capital gains to be done. So where you don't have that interaction, that doesn't also work, because then the information is not there to enforce. And at the local government and the state levels, capacity is a big issue. Everything is still done manual. It's on no basis. There's no proactive measures. It's more or less reactive in those situations. So again, that impacts that ability. And then when we come to the issue of mobility, mobile workers, here again, except now on the frontier issue of digitalization, where you're having people work remotely, prior to that, what you have is what is generally referred to as itinerant workers, who are usually within an income threshold that might not qualify for personal income tax, for example, laborers and all. So again, that might fall into a bit of the straddle the condition around the informal sector operations, for example, and those below the threshold for PIT. So it's not a big issue per se for most jurisdictions at this point in that situation. Yeah, thank you.
Yes, it's not a problem from an African perspective. It's not a tax issue. Africa has also a lot of people outside Africa that are making remittances to their population, and it's a financial and important financial contribution to the country. It's not a tax issue, at least at first sight. Yeah, the idea of capacity, and also the idea of it's not enough to have the information, but you should have also the factual possibility of implementing the law and applying it equally to all taxpayers is also something that it's not so straightforward depending on the jurisdiction, because you have legal privileges, but you have also like informal privileges of some taxpayers that consider that they are not subject to tax because they have decided. So it's an entire process that has to be implemented. Going back to maybe the taxation of wealth, there is a question that is often discussed in literature and during political debates. What is the best way of taxing wealth or wealthy individuals? Is it through having a more functioning, more efficient income tax, or do we have to have specific wealth taxes, general wealth taxes, taxes on various items or categories of wealth? What do you think? Who wants to? Shafiq.
Yeah, thank you. And maybe just quickly to touch upon the mobility of labor, I just would like to say, we often think capital is far more mobile than labor. And of course, now increased opportunities for cross-border remote work, has tax implications. I don't think most of, cross-border remote work is tax driven, but it has maybe some tax implications. And we also see an increase in the number of digital nomad visas that are kind of offered by some countries. So this is also an observation. So in the Fiscal Monitor, it's a publication by the IMF that was published last April in 2022, we did estimate the amount of the personal income tax base that can be reallocated because of cross-border remote work. And our estimate is slightly above 1% of the global personal corporate income tax. That's of course need to be caveated. It's a rough estimate, and it masks some heterogeneity across countries, but that's kind of the global estimates. At around 1% of the global personal income tax can be allocated because of cross-border remote work. On the wealth tax, I would like to say, I would like to get back to my point is, there is some equivalence between taxing the return to wealth and taxing the stock of wealth. And when we say taxing wealth, we mean taxing the stock as opposed to taxing the return. And taxing the return is a capital income tax. So this means if we are good at taxing capital income tax, we kind of, that could be the first step because we have the capital income tax. But if we have deficiencies in the design or problem in the enforcement, then probably we ought to start there. So that's as a general kind of statement. Then when we say net wealth tax, we basically means kind of the net, you need to deduct liability, and it includes financial wealth and other forms of wealth. Now, there are here a couple of points to note. One is that when you have a tax on the stock, that means you are taxing different returns differently, because some form of wealth may not be generating income or may generate little income, whereas other forms of wealth of the same value may generate higher income, but that will be subjected to the same tax, which means effectively you're having a higher tax on low return from the wealth. So that's just one point to be made. The second issue I would like to raise here is that taxing wealth has some difficult administrative aspects. One is valuation. Non-listed shares, some other assets might be difficult to value, and that could increase kind of the burden on the tax administrations in many countries. And then a second effect is the liquidity effect, because some form of wealth, as I said, may not generate high income. At the same time, they may be illiquid. And at this, and then when we impose a tax, then the question becomes, well, is the taxpayer, is there a sufficient liquidity? Now that's an empirical question, actually, to try to understand better what is the size and the magnitude of this liquidity effect. How many taxpayers could be, facing such a liquidity constraint? So that's just maybe that could be different across countries. That could be different across, various characteristics of taxpayer. But that's, I think, one important element we need to think about when we're thinking about the wealth tax at the stock kind of. And one last point I would like to mention, and that is inheritance tax. So that's also some kind of a wealth tax. It exists in many, many countries on papers. It raises very little revenue, hardly 0.1% of GDP in many countries, except for Belgium and France. And that's an issue of equality of opportunity. So then really is just to say that there are some forms of wealth taxes that are out there. They are maybe not exploited to their potential because of the various exemptions, because of the design issues, and they may warrant having a closer look.
Thank you. Yes, you just mentioned Belgium. But actually, it's more, let's say, it's more a statistical trick than reality. The fact that Belgium is supposed to have a high yield from wealth taxes, because there are no wealth taxes in Belgium. There is no capital gain tax. It's just that we've got an apparently high inheritance tax, but which is relatively easy to avoid. But we've got high transaction taxes on immovable property, and quite high, and that counts as a wealth tax. So basically, you pay quite a lot on the market value of the immovable property when you buy it or when you sell it. So that's why it's actually an immovable property transfer tax. Maybe. I don't know if Ang Vardin wants to say something about the wealth tax and what happened.
Well, perhaps one obvious point.
Illustrate how difficult it is to implement it.
Yeah, sure. But I would like to return to the problem of that 1.0% at the top, and replace it perhaps by the problem of the 0.0.1%. I just looked up the figures this afternoon. We have now worldwide 3,400 billionaires. That's not millionaire, but billionaire. They own 12 trillion in dollars together, which is, for comparison, roughly 40% of the US government debt. So it's an enormous and huge amount of money. And if they were all simply Scrooge McDucks storing their money and doing no harm with it, that would be fine. But the guy who was #1 richest man of the world last week, at least, is Elon Musk. Elon Musk has been able to buy Twitter to give Donald Trump back his platform. He has been meddling in the Ukrainian-Putin war by the use of his satellites and threatening, I think, the Ukraine that they should negotiate with Putin. He's having those weird ideas about colonization of Mars. So it can actually be harmful to have people that rich. And the funny thing is that the number of billionaires is growing in each crisis. It may be COVID, it may be a war, maybe a financial crisis, but always, every year, the number of billionaires grows. That's, of course, a far bigger problem than just tax, but it is potentially disrupting societies. And remember Thomas Piketty's proposal for a kind of net wealth tax worldwide. It's impractical, I know, but it's something that we should pick up in some way because it has some urgency.
Yes, thank you. It's
not that I have a solution, eh?
No, it's very interesting because like we started with the tax conversation, now we're discussing something that has to do with tax and has to do with peace and let's say a certain stability of societies. I don't know if someone wants to react about yeah, Saturnina.
Thank you, Eduardo. I think the Spanish experience could be illustrated in answering the question of whether wealth taxes are a good way to raise additional revenues, because, as you know, Spain taxes the ownership and transfer of wealth of individuals with two taxes, the net wealth tax and the inheritance and gift tax. And these are taxes with strong historical roots in Spain, but pose several questions, several problematic questions. For instance, these taxes have a moderate revenue raising potential, and in any case are complementary to personal income tax. For instance, total annual revenue derived from the net wealth tax is around 1.2 billion euros, and the total annual revenue derived from the inheritance and gift tax is about 2.3 billion euros per year. Especially the first tax, the net worth tax, has many detractors in Spain, pointed out its negative effects on savings and inversion. So this is one problem. And the second one is the current legal regulation of both wealth taxes is outdated and inefficient. That's why the tendency in Spain is analyze two possibilities. The first one is the abolition of these taxes by strengthening the taxation of capital gains in personal income tax. And the second option is to maintain these wealth taxes, but make a major reform to modernize and improve the fairness and efficiency of these taxes. I think that at the end of the day, these taxes are going to be maintained because are ceded to the autonomous communities. Autonomous communities which receive the tax revenues of these taxes. But it's important to make a great reform of both of them. This is the situation of the moment in Spain with wealth taxes.
It's not dissimilar from in Belgium. In Belgium, it's because there are regional taxes that they survive. But there are very interesting studies about the reason why, for example, a country like Sweden, which is highly redistributive country with high tax pressure, repealed the inheritance tax. It was basically because it had become so unequal in its application that there was no people support anymore for it. Even if those who benefited most were the 0.01% of the population.
As you know, in the EU countries, Spain is the only one that maintained the net wealth tax. But it's true that in Swiss and also in Norway, I think, in Norway there is also a net wealth tax for individuals. And I don't know if Luxembourg has a net wealth tax for corporations, maybe.
Okay, is there anyone wants to write something about wealth taxation? Yeah.
Yes. Yeah, I just wanted to share the experience of India. We did have a wealth tax till 2015, but the collections were quite low, and it was abolished in 2015 and substituted with a different by a surcharge on higher incomes. So basically, if income is above a certain level, so then additional tax called surcharge was levied. And this surcharge, first levied in 2015 for the super rich, was further raised in 2019. And the results, at least the collections, are many times more than what they were when we had a wealth tax. So it is rather taxing the wealthy instead of taxing the wealth. That is what it has, that is what the experiment or the situation in India has been. but I now see that after the COVID, when the world is looking for more resources, a lot of people are talking about possibility of levying a wealth tax. At the World Economic Forum, 100 millionaires offered to get themselves taxed. And recently some countries, I believe Argentina has imposed a one-time tax, wealth tax. Some other country has also come up with annual wealth tax. And there is a lot of talk about wealth tax being reintroduced because a number of OECD countries abolished it. So the UN Tax Committee, I'm not sure if everyone is aware, is also having a subcommittee on wealth and solidarity taxes. And they are coming out, they have in the papers released so far, they have given a blueprint of what their work would be. They're trying to come out with a publication where they would say what kind of wealth tax it should be, what should be its structure, all the issues that have been mentioned by my fellow panelists today here, like the valuation issue or which asset classes should be covered by the wealth tax. Those issues are being discussed there. So let's wait and see what is the final situation on, what is the next situation on wealth tax globally.
And thank you very much for this very insightful comment. It's true that actually, when you discuss wealth and taxation, you may think immediately about a wealth tax, but you can also think about a better use of like discriminating between taxpayers based on wealth, which is also something that you could imagine to limit, for example, the benefit of certain tax incentives to certain taxpayers which are below a certain level of wealth, or increasing income tax on taxpayers that have a certain amount of wealth. Is something that exists more in the area of social security, where some benefits will be limited for people who have wealth. So the use of wealth in tax matters can go beyond the wealth tax as such. So thank you very much. I can see it's 6 o'clock. It was a very insightful debate. I learned a lot. I hope that the people in the audience also learned a lot. And now back to Suranjali, who is the master of ceremony for the conclusion of this first half day.
Thank you, Eduardo. I think that was a very interesting way to end the day with the panel discussing all new issues on tax. Thank you everyone for attending. Tomorrow we start earlier. It's 8:15 a.m. Europe time, and I look forward to seeing you. They're going to be two very interesting papers, and we have panels there. So I think I would really appreciate everyone joining us tomorrow. And of course, Eduardo will be launching his book as well. So see you everyone tomorrow. Thank you so much for joining.
Thank you. Bye-bye. Thank you
so much. Bye.
Bye.